Hello and welcome to today's morning market on close. My name's Will from the Officials. And before we get stuck into crude flat prices, the big move yesterday was really in gas oil. And it looks like there was a massive short squeeze. We rallied over $4 on the day, as we can see in the chart here, up to over $38 a barrel. It's true the market had been worried about low distillate inventories, particularly in the ARA, but over in the ARA, they've since recovered pretty materially. US inventories are still a little bit low, but it sounds like really a lot of traders were getting in short again, and crowded positions become vulnerable, and stops get triggered. So, I mean, but what was the response in crude? I mean, initially there wasn't too much of a response, but heading all the way back up to flat price. But you can see we did have a pretty big rally back up to that $65 level. But that move has since been faded today, and we're now back at that sort of comfy $64, $50 handle. But turning to Dubai, what's going on there? So if we take a look at the Brent Dubai box, if we can find it here, yeah, we've seen that Brent Dubai box has rallied back up to almost flat at -4 cents. And then if we take a look at Brent Dubai flat price too, we had a strong move this morning back up to -60 cents. It seems like Brent is now outperforming Dubai by the strongest margin this month. So what's going on in the window? If we take a look at our physical premium chart here, we can see we're starting to kind of consolidate, and it's all the same players, with Trafi and TOTS are the only two real buyers. Exxon, Unipec, along with the other Chinese players, remain dominant on the sell side. And, you know, that's a pretty consistent image. That's something we've grown pretty used to over the past few sessions. And that's really been reflected in the physical premium, which we can see is starting to kind of consolidate at this kind of 70 cents a barrel range. And that's dragged the the average premium down to like 103 a barrel, but it looks like it could be going further, especially if we remain consolidated here for the rest of the month. And that implies the Saudi OSP is a little bit lower. It looks like we've dropped an average premium down by about 23 cents compared to last month. So it looks like Saudis are going to be cutting OSPs for Jan liftings again. That's all from me for today. Thanks a lot for watching, and stay tuned for the European window this afternoon.
Hi, welcome back to Trading Corner. We're just going to touch upon the market for the last week and see any ideas we have for the next week. Obviously, we're going into a much colder season. I think we've really felt the weather drop this week, right?
It has, yeah. Definitely about 4 or 5 degrees. Jackets are out.
Yeah.
Jackets are out, yeah. And
are we seeing that play into any products yet?
not yet. I think products are still pretty quiet,
Okay.
actually. Just to pick up from where we left off last week, I think we talked so much about how flow is going to dominate the market, and it's thin
Yeah.
at the moment. It's thin
I
at
think
the
once
moment.
we get to December, we won't do it yet, but once we review the full year, I
Yeah.
think, it's been such a big blur, like so much price action, so many headlines, etc. So I think the market has allowed itself to be this thin now. Like,
Yeah,
you
I
know,
think so.
we've had a lot of price action, a lot of stopping out, a lot of repositioning, exiting again, da, da, da. It feels right now that the market does not want to be in anything, right?
Yeah.
So
I agree with you completely. I think a lot of it is trading in the front of the curve, and,
Yeah.
and traders are focusing on where they need to hedge or any exposure that they have. But beyond that, there's not an enormous amount to really see what the market is doing.
Yeah.
I suppose.
I mean, not to hijack this too much, but I think the last week has been predominantly about crude and
I would agree.
specifically dated Brent. So just going to talk about it really quickly. Maybe you can give your 2 cents from the product side. If
I
you,
will. Yeah.
But anyway, so yes, we had an enormous sell-off in the dated Brent physical differentials. So when we're talking about dated and the products, etc., often what we talk about is the forward curve. Dated's quite interesting because we trade 10 to 30 days out, so it's fairly prompt. You compare that with something like the Dubai curve, you're trading 2 months forward. So it's very much a more prompt market, dated is, which means it is at the mercy of 1 or 2 cargoes of
marginal-
overhang.
Yeah, exactly.
So you see 1 or 2 cargoes that aren't able to be placed, or they're necessarily struggling. You really need to discount these barrels to help them clear, and then you can move on. So I guess this whole mess started with one trade house taking October futures. So they took expiry for October, they took November expiry. I think over the course of it was about 60 cargoes.
Wow.
Here
Okay.
or there.
Okay.
And of course, for any trade house, you go into a play like that and you assume that you're going to place at least 50-60%. You've had those negotiations with your physical
Yeah, off the
counterparts.
market,
Exactly.
Yeah.
And
Yeah.
it's the final kind of 25 to 40%, I would say, that
Needs to
you
clear
know-
in the open market. essentially.
exactly,
Yeah.
you're looking for that incremental marginal demand and seeing where you can price out the rest of the cargoes. So we had the sanction news from Trump. The market really rallied quite aggressively, and it essentially allowed this trade house to
Bid the market.
sell the market. Well, no, sorry, sell
sell
into the
the
market.
market,
So they
yeah, okay.
sold into the paper contracts, which gave them a great entry price versus where they'd bought these physical discs.
Sure.
So then it's a flip of a coin.
Yeah.
Do you price these cargoes strong or do you price them weak? And in this instance, they priced it very weak. So the most interesting curves were WTI and 40. So I think both of them hit 5-year lows on a physical differential basis. So we're talking back to COVID times,
Yeah, I know.
which is just crazy. You're seeing
Proper contango.
a huge contango, and the diffs I think got down. I think the lowest that 40s got down to was around 120 to dated. Midland got to around 130 to dated, like really, really deep discounted to where we were trading a couple of weeks before. And I think over the session we had about 8 to 10 cargoes trade. So they have now cleared, but it's left the market very confused.
Did that surprise you at all?
With hindsight, obviously hindsight
Yeah.
is
2020, yes.
yeah, I don't think the market truly respected how someone can short the paper like that against such a big bull play
Yeah.
that was happening 2 weeks prior. So it was a very quick flip in position. It was a matter of days from there being long positioning to then short positioning. So it was very quick. The liquidity was awful. So, still similar to
Exacerbated the move, I guess.
exactly, and yeah, it was just a bit crazy. But of course, refiners eventually stepped in with these strong margins, and they did clear the
Do you
overhang
think-
in physical, but
Do you think that's the refiners coming out of maintenance though? Because that would be super interesting. Because we talked a lot about, refineries coming out of maintenance and potentially buying more crude than anticipated to push the market up. So
yeah.
do you feel like these barrels have just been taken by the refiners coming out of maintenance and therefore
They have been taken. So the problem was, we were having this very big 3-7 NOV, so literally not last week, the week prior, 3-7 NOV, Cal NOV, a very big, essentially bull play on that week.
Yeah.
That led to a lot of the refiners buying that paper very high. So as the market got crushed last week, they'd done all their paper hedging.
Yeah.
So there weren't very many buyers on the curve.
Sure.
Also, once that price is out, a lot of the physical that's priced against it is also taken out. So whoever came in to buy now, these are very prompt cargoes, as I was saying, you need to have optionality in your refinery to be able to take those cargoes, or you need to be able to have storage. So we were talking about rolls, so a 2-week roll down to minus 70 cents. That will pay for your storage.
Sure.
So there's a lot of talk now about these cargoes potentially going to storage and then coming out for mid-December, because mid-December now is like the absolute opposite story. Like it's so strong on the curve,
Yeah.
and we're getting a ton of buying. The physical diffs are implying a rally up of around $1.50,
That's huge.
which is huge.
That's huge.
It's going from a very, very weak market to a healthy, balanced. The marginal demand is there over
Okay.
the marginal supply. So it's a total 180 on what we've seen the last week or so. But I think
That's super interesting.
what's most interesting is the stark contrast on the curve. If you'd say to me, this is what the curve would look like 4 or 6 weeks ago, I'd say you're absolutely mental.
Yeah.
But it's happened very slowly. The lack of liquidity has been a big part of it. And, I've spoken about it quite a lot, how if you have this kind of like the landscape of, like 2 weeks ago we had a fairly flat Brent spread curve. The diffs were balanced at around 10, 20 cents, like nothing crazy. And the DFLs were, let's say, trading 10 cents.
Yeah.
If you give the market a stimulus, or either way, to be honest, so with the sanctions in this instance, the economic environment is so different for the physical barrels.
Yeah.
So it's no wonder that someone is going to take advantage of that fact.
Of course,
Especially if you own the cargoes, you'd kind of be a bit stupid not to hedge at that level.
Yeah.
So you've taken the paper from such extreme environments, and the buying behavior for the physical hasn't changed,
Okay.
which means you've allowed a totally new entry at a much higher level. The market is going to increase in volatility, it has to.
It must be. Yeah.
Which means the physical can then also trade in much wider ranges. And that is what we had, and I just don't think, me for sure, I was not expecting a move like that. It was, a huge
move,
sell-off.
yeah.
So now that's kind of done, it lasted a week. I don't think we're going to see the same weakness this week. I think it's probably going to get caught in the middle a little bit. Next week is the real bull play. So between now and then, I do expect the market to remain fairly supported. We've had this flush. The trade house has done what he wanted to do and now can step back and let the market kind of rebalance again. Alongside that, I know I'm rambling a little bit now,
go for it.
but we saw a really good rebound in the front Brent spreads over the last couple of days. Let me know how it's impacted your market, but for us, we've got a rally in the physical diffs, we've got a rally in the DEC Jan dated, and we've got a rally in the Brent spreads. The whole curve looks so firm.
Yeah. So I'll tell you what's going on the product side.
Yeah.
So proms and margins have corrected off substantially across most products. Actually, naphtha, gasoline, fuel, all lower.
What about gas oil?
Gas oil is gas oil's there.
Yeah.
It's kind of been stuck. It repriced to a new high earlier at the beginning of last week, and it's kind of just oscillating around
Drifting.
now. Yeah, it's drifting.
Because
It's
I think
drifting.
our research team was suggesting that open interest is starting to drop.
Drift,
It
yeah.
might be a natural, you're going into Thanksgiving, you're going into Christmas season, people are like, let's take a bit off the books.
Yeah.
Is it much more than that?
I don't know. I would imagine it's actually probably that. It's probably the fact that there's a lot of taking off the books, but we see the back end still holding.
Yeah.
Back end margins are probably on a net basis slightly stronger than what we talked about. So the boxes have compressed a little bit just from the very prompt, I suppose.
Yeah. So we're seeing the front Brent spreads are rallying. So the front product spreads are coming off quite a bit then.
No, I wouldn't say the product spreads are coming off necessarily. It's the product cracks that have sold off a little bit. In the
Okay,
front.
okay, fine.
Yeah.
So it's the outright.
Yeah, exactly.
Well, yeah, I guess Brent spreads can rally and it will still imply the back higher, right?
Exactly. But beyond that, I think it's actually just really quiet
Yeah.
on the product side. It's been, we discussed a lot about we are in a high margin environment, right? And we've got a lot of supply disruptions from, refinery disruptions
Yeah.
all over the world.
One after the other,
Yeah,
right?
it's just
So like-
non-stop,
yeah.
right? So we talked about an $11 a barrel margin, $10 a barrel margin, $9. They're all still very healthy, positive margins, and so it can create an environment of much higher volatility,
Yeah.
right? Because you can see hedging at 10, 11, 9, and people, those who miss hedging at 11, may still come and hedge at 9 because it's still very profitable. And so I think at the moment, from the product side, everyone is going to be watching the distillate complex. The gasoline complex has been a bit shakier. I think we talked about this a little bit last week. The U.S. is still pretty tight. Stocks are low in Pad 1, and there's still a lot of strength in the U.S. gasoline market.
Yeah, I read about is it the jet market in the US looks pretty strong. We're getting some exports from India into the US, so it does feel like still the product demand is out of
The U.S.
the West, right?
Correct. And so freight's still a big factor, but I think at the moment products look a little bit jittery. They just look nervous. I think we could swing up and we could swing down, and I think it's more likely we swing up than we do down, certainly for me. But a lot of it will be heavily crude dependent, and I think crude is the big potential solver.
There's a lot of question marks over, we had some breathing room for these sanctions to come in, and I think the deadline was something like 21st of November before a lot of the the G7, whatever you want to call it, have to stop buying Lukoil's and Rosneft's oil. So they had a bit of time, which led to the market not really reacting that aggressively. You look at the Dubai curve, totally flatlined. You look at the dated curve, it's got totally annihilated. And the TI spread's not doing particularly well. Everything on a crude basis looks pretty undervalued given these sanctions.
Yeah.
So it could be that you just have this time lag, and we have to wait until the first deck cycle to really see this buying come in. But even so, it's showing that the appetite for the forward curve is just awful. So
it is.
If these sanctions get resolved and OPEC start coming out in Q1, I know they're saying they probably won't, given the potential oil gluts. You can see that the underlying market is weak for crude, and you're needing these supply shocks to keep it elevated.
Correct.
Which is a really dangerous environment to be in.
We had a report recently from the IEA about the fact that they're cutting their demand estimate to 4 million barrels a day lower than what they anticipate supply for next year. And
I mean, that's massive.
It's huge.
Yeah.
It's just huge.
Yeah.
And so I think that's a lot of the reason why, even in the product markets, there's a little bit of uncertainty. And so actually, for me, I prefer to hold my risk further back where I think the risk reward is.
Yeah, it's an environment where this kind of idea of contrarian trading, etc., is not proving too well. Exactly. So I think you just want to be riding those kind of short-term momentum moves. I think the market's going to be really reactive to things like headlines, stats, stopping out, all these things. That the vol is there on the curve. So if you can catch 10, 20 cents, perfect, but it's not a market to get really married to the curve to.
I think so. Yeah, and particularly not a market to get really married to differentials.
Yeah.
As we've discussed a few times, I think a lot of the cross-product differentials or inter-product differentials are at way out of whack from where they have ever been.
Yeah.
And we've heard that time and time again this year. And so I think it's prudent to just be cautious that we may have just found a new normal.
Yeah, exactly. We've got refinery disruptions, we've got high margins, and we've got a weak crude market.
Yeah.
We could be in this environment for another year.
It could be, yeah, absolutely.
Who knows?
It takes so long to replace a refinery to
Yeah.
get someone to come along. And even a year is nothing in that
Absolutely.
sense,
So yeah, it'll be interesting. I think we'll see a continuum of wind downing in positions, especially as we go to Thanksgiving. The main trades on the board, I mean, it's undeniable this crude strength you're seeing now on the forward curve, but let's see, we need to see some physical bids for that to really get realised. I'm assuming it's going to come in towards the end of this week and next week, but there is much healthier buying appetite on the curve. So to me, it looks like crude is the upside here, but just be careful, headlines, etc. And then products, how are you feeling?
I'm still
In the back.
For me, my risk reward for me is in the back. Yeah,
Yeah.
I like the second half 26 margins. Not all of them necessarily. Like you could trade a bit of relative value. I certainly think I don't mind gas oil. I think it's a lot. You're removing yourself from the front noise in gas oil. You're giving yourself some long crude spread exposure at the back across all of those.
Yeah.
So I don't mind second half 26 gas oil cracks and naphtha cracks, even to some extent fuel cracks. Although we've seen a decent amount of correction down at the front in fuel. Gasoline, I'm not particularly bullish, or certainly as bullish as everyone else is,
Yeah.
or has been.
It's hard in the winter, right, to really make that call over anything else.
Yeah, you can see. Look, it is difficult in the winter, but this is not necessarily just a seasonal trade. I'm not talking about it necessarily from a seasonal perspective. I actually mean from just a pure price perspective.
Yeah.
I don't have that much, an enormous amount of conviction in long gasoline in the front, or in deck in Q1, let's say. I also think it's the strength in gasoline is probably bringing a lot of support for the strength in blending components.
Yeah.
And so, if gasoline does give way, then we could see an interesting market in propane and naphtha as well, because they could be held up for a bit and follow, or we could see some blending margins actually normalize to a slightly less high level, I suppose.
For sure. Okay, so everything else, freights kind of remain the same.
Yeah.
It looks like the rest of the market is kind of holding as it is. I think it's the inactivity on Dubai that's the main concern. I mean, it's quite interesting to see that curve is just not moving.
Just not moving, right? Yeah,
so
exactly.
I think the market is still looking for what the East are going to do. If we get a leg up in Dubai, it will help data to stay up. But you look at the curve now, data Dubai is rallied a good 25, 30 cents. So it's really data that's done the legwork so far.
Sure.
But it's the way of the world. If people want to position long in data, it probably will price there. So I don't think it's a time to really go short against someone that has very good entry levels into dated, given the sell-off we've seen. Okay, so I'm going to stick personally with my long TI Brent box trade. I think the only caveat is, if this cold weather starts to hit refiners in the US, we could have a little bit of a problem. Also with the contango in the front of the curve, I'm assuming a lot of the ships are taken out for storage.
Correct.
Freight's still super high, so it could lead to a bit of a glut in the US. But for now, I think we're okay. I think TI's probably hit the lows into data that it's going to see for a while. So I still like that trade, but you can't deny the long deck Jan. I think you have to keep that.
So I personally think that with the cold weather coming in, it like you said, and we've discussed this previously, over the last few years, the cold weather snaps have come later and later and later.
Yeah.
I would say 5 years ago, it used to be pretty cold in December, and now that's been moving to mid-January to mid-February.
For sure.
Right?
I mean, we were 15 degrees last week, right? Very warm winter so far.
And weather is becoming more volatile.
Yeah.
But I do think something to keep a real note of is refinery capacity, because we're already losing so many refiners. We've lost so many refiners. We don't have much refinery capacity across the curve, across the globe. Sorry. And if we have a cold weather snap that starts affecting refineries, we could see products rip again.
Again, yeah.
You know, so
It's very believable that
yeah,
that
yeah,
will happen.
exactly. So and this time it'll probably be even more aggressively led by gas oil, because we are in the seasonal peak demand, coming into the seasonal peak demand for gas oil.
Yeah.
So,
Okay, cool. So are you sticking with your back end
yeah,
margin?
long back end margins.
Okay, great. And for me, TI Brent and TechGen dated.
Cool.
Let's see how we get on. Thank you.
Thanks.
So I guess, do you think this case marks the start of, I mean, what has it changed, do you think, in your view?
So I think the relationship between illness and covenants had never been considered before, and it's clear blue water with the other cases. But I think it also marks a general approach of the courts to be more willing to enforce non-competes.
So Adam, thanks very much for joining me today. This is your first podcast.
It is. First of many, no doubt.
Yeah. Well, it's unusual for us too, actually, to be discussing a legal case, right? Usually we're very much on market dynamics, that kind of thing. This was a big case for Onyx, big case for Dare and the individuals involved, of course, but there's for sure ramifications in the market, non-competes, contractual type things, and I'm sure there's a lot of eyes on this. There's Bloomberg reports and all that, and we can get to that later. But I guess just to frame the discussion, could you summarize in your view what this was really about?
Yeah, I mean, in some ways it's a straightforward case. What Dare wanted to do was to enforce the non-compete covenants that it had with its employees who'd resigned. So a couple of employees resigned, actually a whole tranche of employees, and most of them I think went to Onyx. But Dare wanted to enforce the covenants, and that's a standard sort of case where ex-employers are saying you've got to comply with your covenants. What was interesting and different about this case was that there was a long notice period, so there was a year-long notice period, and both employees, both defendant employees in this case, were off work, and they said they were ill through the notice period, so they weren't at work. And Dare said, well, it doesn't matter that you haven't been at work for that year-long period, we still want to enforce a year's post-termination non-compete afterwards. And that was the point that the court was considering, whether you can enforce 12 months plus 12 months in effect.
But is it, you say it's normal, but is it not unusual to be starting this dispute within the notice period? So having a case proactively to get people to adhere to things?
No, that's not desperately unusual.
Okay.
I mean, I've got a few of these cases on the go at the moment where people resign and then say, I'm not going to confirm that I'm going to comply with my covenants. And then the employer says, well, in that case, we're going to apply to enforce them.
Okay.
And there was another big case involving traders, actually jump trading case, where that happened. It was another year-long notice case. And the problem that Jump had in that one was that they waited until quite near the end of the notice period before they started litigating.
Okay.
And that caused a whole load of problems for them. But it's not, the fact that you go in your notice period isn't particularly unusual.
Okay. But to state the elephant in the room, though, what was it really about? What was really at stake in your view?
I don't know, what is the elephant in the room?
Well, that's because, I think it's very unusual. I certainly wouldn't have litigated. Once I've had staff leave, they leave. And you move on and you say, well, look, I've got to rebuild.
Yeah, okay. I guess, you're Onyx. And I suppose the elephant in the room for that case is that it was a business against business dispute. And so the vast majority of the cases that I do actually are about two businesses fighting and trying to prove to the other that they're the big dog in the
So in a way, not unusual, again.
No, it's not unusual at all. I mean, the employees are more often than not pawns in the pawns. They don't play a significant part. And especially when they're highly remunerated, the new employer will be paying the legal fees more often than not for the employee and will be indemnifying them. So the employee's really not got that much skin in the game, and it's a battle between two businesses, and they're both trying to stake their claim on the ground, on the terrain.
Because the case was officially Dare versus the individual.
Yeah, exactly. And Onyx weren't in it.
Yes. But I think the judge, I was amazed at how quickly it was essentially assumed that it was effectively Dare versus Onyx. That's the way it came across. Because I guess that's normal.
That is normal.
Yeah.
And I was in a case that went to the Supreme Court, which is unusual. In this area of law, what normally happens, if it gets to court at all, it gets to court for a contested interim injunction. And when the court grants an interim injunction with penal notice on it, that's normally the end of the case. One side knows it's going to lose, the other side knows it's going to win, and it normally settles. This case is unusual because it fought to trial, so there aren't that many trials. 99% of cases settle before they get to trial, so that's unusual. And the vast majority of cases don't go to appeal because they happen so fast and things are so time dependent. But I had a case which went to the Supreme Court, and there were 3 or 4 hearings in that at different stages, and at no time did the employee ever turn up. So it went all the way to the Supreme Court and the employee wasn't there. And everyone knew, the Supreme Court knew, it's not really about the individual, it's about these 2 businesses fighting out amongst themselves.
But the court ultimately did uphold a 12-month non-compete. But how did they, in your view, convince the judge that the information they had would stay commercially sensitive for that long?
I mean, what you've said is accurate. The court upheld a 12-month non-compete, but for one of the employees refused to enforce it, and that was absolutely crucial.
Okay.
So there's a whole series of questions that you've asked me there, but I think the bottom line, the sort of fundamental question is, why did the court say, I think this non-compete is potentially enforceable? I say potentially enforceable because the court did enforce against one defendant, Hikmet, but not against the other defendant, Solomon. So it was potentially enforceable because the court said that there was confidential information that the ex-employee had. Now, the classic way in which you justify a non-compete is to rely on confidential information. So the starting point is that all covenants in restraint of trade are unenforceable, and then it's for the employer to say, it's protecting one of my legitimate business interests, and confidential information is a potentially legitimate business interest, and it goes no further than is reasonable. And it's for the employer to justify that, and for an employment restrictive covenant, the court looks at it with a degree of scrutiny. In this case, the employer said, I'm protecting confidential information. That's not the only way in which you can justify a non-compete, but that was what they did in this case. And there is a bunch of information that's confidential. And what happened, and I think to some extent the judge was persuaded because it all looked very technical. What happened was Dare said, look at all this information on spreadsheets and look at all this pricing information. And a different judge, perhaps more immersed in the industry, because this judge just didn't know anything about the industry before this case, made that clear, a different judge might have been a bit more sceptical about that information. But what the judge said was, even though you haven't taken any confidential information, you may be able to dredge it up from your memory in the future. And that seemed to me to be a very generous pro-employer
That's
approach.
what I was going to ask you.
Yeah,
the judgment
exactly.
was treating memory-based knowledge as confidentiality, which, is that not a slippery slope?
It's not unusual.
Okay.
It's not unusual to say the fact that you can remember something, the fact that you haven't got it in a document isn't determinative. So if you've got 2 employees, one's nicked a bunch of phone numbers and the other one has got a retentive memory and knows all the phone numbers, there's no reason why you can't enforce against both of them.
Okay.
Because it's the same information, they've both got it, one's just memorised it. But what's unusual in this case is that it was intricate information. It wasn't pinpointed what information the individual would remember, and the judge didn't care. He just said you could dredge it up at some future. He didn't even identify what it was that could be dredged up. So the judge took a very broad brush approach towards memory, which is, from your perspective, you're honest, enforcing these covenants, that's great.
Well, I guess because we are the complete other side, where we know, if anything, the technical detail very strongly and the best, and weak on the legal side, it was a complete reverse for us, because we're saying there is nothing. We can all recreate these are basic spreadsheets. We were trying to get this across. I mean, we sell these spreadsheets basically for nothing, pretty much for free, as a lead lag to our other services, because they're so readily available. And
Yeah, exactly. So I think a judge the judiciary in general, they're lawyers. They've been lawyers for 20, 30 years, and they're now judges. They're impressed by technical spreadsheets. It looks complicated, therefore it's probably confidential.
On that kind of same point, what about the regulatory side then? Because that was something that was important to us because of the way we see, you know, the exchanges, the brokers, the kind of setup, regulatory setup that we have right now. We felt very strongly that ICE in particular had a special relationship with DARE, and they didn't actually deny that. And then there was also the case with the brokers as well. And these are all against the kind of FCA rules, and we wanted to emphasize that. And I think maybe that was done perhaps with the other barrister by the Hikmet. I think you might have avoided that from memory.
Yeah, well, it didn't
factor into
it. Didn't factor. I mean, so yeah, we did take slightly different approaches. Niran De Silva, who was for Hikmet, did take more of a proactive approach on the regulatory front. My view was the judge isn't going to be interested in this, and he wasn't.
No.
And so I was right. I think it's not impossible that a differently formulated case with different regulatory background could work. So you could say, for example, your covenant forces me to act in breach of my regulatory obligations. Therefore, it's not in the public interest to enforce this. But I don't think the evidence in our case went far enough and wasn't clear enough for the judge to take a view. And what the judge didn't want to do is tread on the toes of the regulators, because that issue wasn't before him. And so he was being asked to make a decision on regulatory matters which haven't been pleaded, which hadn't been argued, which wasn't an issue in the case, and he just wasn't going to go anywhere.
And it would have set a precedent.
It would have set a precedent, and not necessarily the right one. And the judge didn't want to go near that. So I think if you're going to take a regulatory point, the case has to be stronger, and it has to be run that way from the start.
So I guess, as we said, there was two kind of sides to this, even though there were similarities, but the two outcomes as well. But what do you think tipped the balance legally and morally, I guess, between the two?
You know, it's not complicated. It really isn't complicated. I think the judge found that Solomon was ill and Hikmet wasn't.
Okay.
That's it. And so when someone's off work because they're ill, they're not simply they're not refusing to attend. And for Hikmet, what the judge says is you weren't just refusing to attend, you were actively working for Onyx during the notice.
That's what he found?
Yeah.
Okay.
So he said you were dealing with Onyx, you were giving them confidential information, and therefore I'm going to enforce the post-termination restraint and give a bit of springboard relief in addition to that. So you get not just the post-termination restraint enforced, but you get springboard relief, which is judge-made relief, cancelling out the advantage for your wrongdoing. Now, I think this was a very odd decision in respect to springboard relief. Normally, springboard relief should be for a period of months, and this was for 4 weeks only. It's not clear why he made that decision, so it's not clear what material advantage was gained by Onyx or Hikmet by whatever he'd done. But the big difference between Solomon and Hikmet was that he said Solomon was ill and Hikmet wasn't.
So that's clear, but at the same time, if we're talking a kind of moral argument, effectively you're saying, I believe you, I don't believe you, and by inference, you are effectively a liar and this kind of stuff. Okay, but there was absolutely no, or from our point of view, no appreciation. I mean, the judge said at one point, the behavior around the resignation process was extraordinary. Again, kind of emphasizing that Ashley, I guess, didn't behave very well. But what about all the evidence about how Eamon and Jono and Dare had acted? There seemed to be no kind of appreciation of how awful that all was, and let alone, so that's one thing. But then add to that, you know, recording someone privately. When we talked about that openly when it first happened, everyone was shocked. I mean, that's not going to hold up in court. You can't use that. There wasn't even a mention of it. It was just completely taken as yeah. What was that about?
I agree with you. No one came out of this smelling of roses. And in terms of who won and who lost, I don't think Dare was happy with the outcome. I think they were spitting blood at the outcome.
You think?
Yeah, definitely.
But what else could they have got?
Well, they lost against Solomon.
Lost against Solomon, but he'd still been out for a long period of time. And in our view, it was just about keeping him out anyway.
But they didn't manage that.
But he'd been out for 18 months when he could have
Yeah.
only been out for 12. So they kind of got, what, they got 6 months less.
I mean, well, I'm convinced they were furious about that outcome. I think they got it wrong. I think Dare simply misjudged it, and I think they probably were undermined by their legal team. Probably. I think their lawyers thought the outcome would be different to the way I thought. Right from the start, I thought, this guy's been ill, they're not going to enforce for a year. That's it. I think that's what this case is about. And I suspect Hikmet thought that too. I've been out and therefore they won't enforce. I think Hikmet was unlucky and I think the judge took against him. But it isn't really a case of who's behaved worse. That isn't what the judge is doing here.
But he did mention it. He did make an inference that he didn't like the way Ashley behaved.
Yeah, that's because he was considering a breach of contract claim. So in the context of the allegations against him, but there wasn't a counterclaim against Dare.
Right.
So you're not weighing up conduct in that way. Just because Dare had behaved in a way which you or I might not behave, secretly recording people, doesn't mean they still haven't got a breach of contract claim.
Should that not have been, on retrospect, in hindsight, they should have countered aggressively early about that then? They should have made that a contentious issue. Like, well, hang on.
No, I just don't think it matters.
Okay.
I think the law is that illegally obtained evidence is normally admissible. So if I break into your safe and find out lots of juicy information that I can use against you, the court doesn't say, but you stole it, so it's not admissible. The court lets it in.
I've been watching too many crime shows then, and US
crime
law
shows,
because it's the opposite is what I thought. I mean,
Yeah. Well, ask a barrister.
clearly. Well, as I
Or
say,
do a podcast, maybe.
yeah, it's good to know, right? I mean, this is the other thing for
I'm
me.
not suggesting you break into people's safes to get information.
But, you know, it's just because, I mean, taking all the legal side out of this, we as just people, employees, employers, you kind of have, and it's the same with regulation, you kind of live by a code that you assume holds you together, but it's really kind of fantasy until you test it. And this was testing it. So you have a contract, and by the way, for the longest time, you know, we've been trading for 13 years from our last place through to Onyx, and all throughout the way of signing contracts and writing contracts when we were the employers, it was always, these non-competes aren't really enforceable, but you can try.
Well, okay, I don't know why you say that. I mean, if that was right, I'd be out of a job, because a lot of my work is enforcing non-competes.
Yeah, I think the way it was
I win non-competes, by the way.
No, fair enough. It's just I'm just
if
telling
you want a barrister to win it for you.
Yeah, so that might be black and white, but then the next layer being like, and there's a certain way to behave. Clearly, that's not really true.
Well, I don't know. Judges are humans too, and if you've behaved, you know, there was a senior barrister in my chambers that always used to say, and he didn't use this word, he used a much worse word, but he used the bad person is the person who loses the case. And he didn't say bad person.
Yeah.
That's
not what happened, though.
Well, it kind of is, because I think the judge thought, I think Hikmet's not telling the truth. I think Solomon is telling the truth. Therefore, Solomon wins, Hikmet loses.
Okay.
And it doesn't really matter how reprehensible Dare have been. I mean, that might have had an impact at some level on costs for Ashley Hikmet, not paying all the costs because of Dare's conduct, and it was pretty unpleasant. And you know, he might have been able to say, "You've invaded my privacy" at various points,
Right.
but it was in a public. He was recorded in a public area. I suspect when Dare used private detectives, they crossed the line. But I've got no way of knowing that. That was my gut fear. I've no idea. They may or may not have done.
Well, there are a lot of other employees who didn't end up going to trial who make that exact claim. But again, it's the idea that this behaviour is acceptable. You've just said it, I'm repeating myself, but it has no bearing on the case. And I think that's quite shocking to people. You expect there to be some kind of person or authority.
Yeah, I mean, there was no suggestion that the evidence they obtained was unlawful either, I should say. I mean, I've talked about unlawfully obtained evidence. I'm not suggesting they broke into anyone's safe. The breaking into a safe is a case. So there was a case, a divorce case about divorcing couple one broke into his, I think the husband's safe to show that his assets were much more than he claimed. But there's no suggestion that Dare, in this case, obtained evidence unlawfully. It's just a bit distasteful to record people's secret.
Well, I was going to ask, so you talk about being undermined by legal representation. Do you think, though, some of the way this evidence was obtained was aggressive? You know, the kind of some of the exploratory things. I forget the legal wording when you demand to see people's phones and things like that. You know, every stone was
Turned.
not turned, yeah. And is what I'm trying to say is you kind of get what you pay for a little bit on that front. And these were this is Allen & Overy. This is the top, well, at least the most expensive law firm in the UK. And I guess that's what you get. That's kind of what they can deliver you is bulldog type mentality, I guess. Is that fair?
They pressed hard, yeah.
Yeah.
I mean, the other trader case that I was doing the year before Dare was called Jump Trading. Allen Overy were on the other side in that as well. And that case they withdrew halfway through trial. So it went very badly for them. And I think they got burned in that. In that case, they did sue the new employer. I was instructed by the new employer, Verishian, who was in the Onyx position in our case. And Onyx weren't a party, so he didn't have a barrister. But they did. So I think what happened, A&O learnt from changed their tactics because of what happened in Jump.
Right.
So they did bring the new employer in Jump, and they didn't in our case. And I think they should have done the opposite in both cases. So I think they're sort of learning or changing their tactics. I can't tell you that's right because I haven't talked to them about it.
But I
think they did a good job in Dare.
That's what I mean. I think from my own experience, and I unfortunately have quite a bit now, and it's just, there's no guarantee your legal representation is going to be willy-nilly doing everything you ask. They have their own view on things, and I think it was, at least seemed unusual to get someone so aligned with you, like whether or not they believed in it or not. I mean, usually you look, Greg or company or whatever, you're overreaching here. That's not the way the judge will see it. We got a lot of that. The judge won't like that. The judge won't like that. I don't know if he didn't seem to care what the judge liked. They said, we're going to throw everything we can at you and see what sticks.
Well, I don't think it did work.
No, but I guess what I'm saying is it got a lot further than I feel like it should have done because of someone, and I was only there in person one day, and it was, you were quite clearly building articulate story and a logic train and, all this kind of...
I can't remember.
I was the first day Eamon was getting...
Cross-examined. So I was cross-examining him?
Yes. But there was the other side also chipping in and wasn't interested in hearing the responses so there could be a dialogue that creates a story and an end point. It was accusation, and just, it's there now. And that seemed to be the approach. Just get everything out there and accuse, and don't worry about whether the whole thing makes coherent sense. At least anecdotally, that's what it seemed like.
You never know what the other side's
strategy
is. You don't know what their client is saying. You don't know what the solicitors are saying. You don't know what the barristers are saying. I think it was complicated leading up to the trial because there were lots of issues about confidentiality and medical evidence, and these were litigated hard, and it was and in private, and it was very complicated. These were complicated, complex issues, and there were disclosure issues, and it's easier when you're for the claimant to demand documents, I think, because as a claimant, you haven't got the other. So you're saying, I think bad stuff happened. I'm sure there are documents which exist, and the other side can't say that back. So it feels, you on the defendant's side, it feels like you're always under attack, and it feels like you're not advancing your case properly. And that isn't the reality of the position. But I understand how it feels like that.
Fair enough.
But I don't know that A&O were doing Dare's bidding and any more than the lawyers you had weren't doing your bidding.
We had very defensive lawyers, and we had the problem of having lawyers for each, and it was not even just these two, there's others involved, and they are, on retrospect, they're obviously incentivized to keep things vague and keep things ongoing.
Well, I can see your issues. The problem was, from your perspective, individual legal teams are acting for the individuals and not for you.
But even better than that, their client doesn't have to pay them. The company has to pay them.
Perfect for the client.
Exactly.
But so they've got their
Yeah.
clients' best interests at heart, and that may not align with yours.
Right.
And your legal team didn't have a fighter in the ring, so there's only so much they could do.
Yeah, it was coordinating. It was a tough job. But I think from a legal strategist point of view, then I guess you've kind of answered already. But the evidence that actually wins or loses a case like this, you talked about the medical examination, the documents, the cross-examining.
Yeah, I mean, what was unusual in this case is the medical issue, the fact that illness was a factor in whether or not the covenants could be enforced. And I haven't come across a case like that before. I think it was a first.
Okay.
So there wasn't a precedent for that. And Dare were litigating it as if it was litigating the truth or untruth of the illness, whereas the judge decided that so long as there is a basis for accepting the employee's evidence, that's what the court should accept. So you don't have to determine whether or not, precisely what the illness is.
But then why was Ashley...
Because the judge didn't think there was a basis
Okay.
for determining he was ill. And what happened with Ashley was that he never actually saw a doctor. His dad knew a GP.
Right.
Ashley spoke to the GP once on the phone, never again. And after that, the GP just kept signing him off as sick, never having seen him for
Okay.
months and months and months. That's a regulatory problem. And the judge thought that's not good enough.
So I guess, do you think this case marks the start of... I mean, what has it changed, do you think, in your view?
So I think the relationship between illness and covenants had never been considered before, and it's clear blue water with the other cases. But I think it also marks a general approach of the courts to be more willing to enforce non-competes or to uphold them, and to say, in respect to confidential information in particular, it doesn't have to be that confidential or that persuasive to get over the threshold to justify a non-compete.
But isn't that at odds of what the government, or at least the Labour government as it stands, is trying to do? I thought we were trying to move away from non-competes.
I mean, is that what it's trying to do? You tell me.
Yeah.
I know that a few years ago there was a suggestion that non-competes would be outlawed or limited to 3 months. It's never happened.
Okay.
And the government's got enough on its plate
Sure.
to this. If I was the government, this would be way down my list of things I wanted to spend parliamentary time on. And what difference it make? The truth is, the best person to decide whether a particular covenant is right or wrong is not the government, but the judge, having heard the facts. And I think that seems to me to be the reality, and that should be the right approach. And it is. That's what we've got at the moment.
And there was that whole thing about jurisdictions as well, because this is actually a Dubai office they were going to, but I guess that didn't matter. Or if they had gone to Dubai and started straight away, you would still be infringing on UK law.
Yeah. So there's an order of the court here with a penal notice. I don't know about enforcement in Dubai, but what you can do is what happens is they contact the enforcement officer in a different country and say they're in breach of a penal notice, and try and enforce. Or if the individual comes back here to this jurisdiction, they'll be in breach of the order, and an arrest warrant will be issued. And also, in a classic situation, as long as you serve the order on a third party, for example, a new employer, and the new employer has the order, if they induce a breach of the order, they're in contempt, even though they weren't a party. So you guys could be in contempt
Gotcha.
if you're in breach.
And
So
I know-
so long as you've got premises here, they can enforce against you.
And I know this isn't really relevant, but the US have talked about, or they have ruled, I thought, in some states, that non-competes aren't even enforceable full stop.
Yeah. So some states enforce, some states don't enforce, and some enforce in a weird way. So it changes from state to state.
Okay.
And that matters because sometimes, that matters here, because sometimes people with, I don't know, a Delaware or a Californian contract with covenants in come here, and they want to try and enforce it here. And what the courts say is, well, we first judge whether it's reasonable on the basis of the law of England and Wales, but if it's unenforceable there, then it can't be enforceable here either.
And was that not relevant in this case?
No, because it was a UK contract.
Okay.
So you can have a UK worldwide contract. And the fact that it's... So I've got a non-compete against you, and the fact that Dubai doesn't enforce, for example, if that's the position, doesn't mean that the UK won't enforce here. It's coming the other way. But
just to quickly go back to the judgment, it was ambiguous, I think. I think that's hard to deny. And I guess in our mind...
What was?
The judgment itself.
Which bit?
Well, collectively, to say, okay, to give an example, Bloomberg said, Dare wins the case. And then we say,
Bloomberg's wrong.
Exactly, and one of the first
they're
things...
wrong. That's not ambiguous.
Okay.
They didn't win.
Yeah.
I mean, Solomon won and Hikmet lost. So Dare won against Hikmet and lost against Solomon.
Mm-hmm.
That's the reality. There isn't an ambiguity.
So how does Bloomberg get that so wrong?
Got it wrong. Phone Bloomberg and tell them they got it wrong.
I did, actually. He asked me to quote. Whatever.
You can ask him to contact me if you want.
Yeah.
I'll tell him the answer.
No, he said, well, if you read on the article, it explains a bit more. Mate, you've put the headline, that's clickbait, like it's done. But anyway,
I don't think they did win.
Yeah.
So, Solomon made an application. The winning team normally gets its costs paid by the losing team. That's the cost follow the event in this jurisdiction. And we made an application for our costs. And we wouldn't have done that if we'd lost. So Hikmet didn't make an application for his costs. He was trying to resist paying costs. It settled. As you know, there was a global settlement before this was determined. But the fact that we were going to make a cost application indicates what the underlying reality was. And
again, the ambiguous part was we weren't sure, does that mean Stephen can start right now or not? That was also up in the air.
Yeah, that's a really interesting question. I mean, the answer is yes. But what Dare did, and it will never be determined because it settled before it came out, was say, okay, the court is not willing to enforce the injunction, but the contract is still enforceable. So we can't go to court and get a court order to enforce it, but the contract's still there. And if you're in breach, we can sue you for damages. And what Stephen said was, that's wrong. You've got no loss because you've got the benefit of me being out of work for that period of time.
Yeah.
And they said, well, that doesn't matter because we've still got an enforceable contract. And so that issue was going to be determined.
So had it continued, this whole damages part would have been complicated as well then?
It would have been litigated. You know, I think it was pretty clear what would happen. But also, what happened was that Dare got an interim injunction stopping Solomon and Hikmet working pending the outcome of the trial. Mm-hmm. And at trial, the judge said, I'm not going to uphold the injunction against you, Solomon. And the price for obtaining an interim injunction is that Dare promised to give a cross undertaking as to damages to Solomon. I would compensate you if I'm wrong, because I've got an interim injunction. If I'm wrong at trial and it isn't upheld, I'll compensate you. So what Solomon had was an application to enforce the cross undertaking of damages as to damages against Dare. And Dare was saying, well, you've got no loss, but also we've got a damages claim against you. And we said, we have got loss and you've got no loss. So that argument was going to
would have been messy, but
would have been fun.
I guess final question then: if we'd appealed, then
who? Hikmet.
Yes.
So we didn't have an appeal.
Didn't have to appeal, did you?
Well, you appeal an order. Okay, you don't appeal the judgment.
Okay.
So you appeal the order. The order against us was they sought to enforce the covenant, and the covenant was not enforced. And so we couldn't appeal that. Mm-hmm. Dare would have wanted to appeal it.
Okay.
We could have put in what's called a respondent's notice saying, well, we want to uphold the judgment for different reasons, like, for example, the covenant, we don't think the covenant's enforceable at all. But only Ashley Hikmet put in an appeal, and he had a whole series of grounds for his appeal.
Mm-hmm. How do you feel like it would have gone?
I think they were arguable. I think he would have got permission if it had gone forward from the Court of Appeal.
It just would have just dragged on a lot of costs and...
That's a good thing.
Yeah.
From a barrister's perspective.
From a barrister's perspective, but ultimately, this was 18 months and we settled and I think we're both happy to do so. But you did say that they were unhappy, you think. I'm surprised to hear you say that, actually. But
well, I don't know what... I'm just a humble barrister. I don't know what the global settlement was. So you know more about it than I do. But I think on this case, I'm certain they were spitting blood.
Good for you.
Yeah?
Adam, thanks very much.
No, great pleasure, real pleasure, genuinely.
Thank you. Well, hello and welcome to the New Look Hedging Show. I'm Lisa Aziz, I'm your host. And sitting alongside me for today's illuminating session are Tom Fawcett and Harry Campion-Evans, along, of course, with all their expert knowledge. Well, just firstly then, Tom and Harry, tell us a little bit more about yourselves and what you do here at Flux Onyx.
Thanks, Lisa. I'm Tom Fawcett. I'm head of dealing for Flux Market. So I look after all of the products that we offer on the platform and managing all the risk associated with trading those products.
Hi, Lisa. So I'm Harry Campion-Evans. I've been with Onyx Group since the inception, basically. I was one of the first employees. My background is derivatives trading and broking. And then as of this year, I'm a director on the Flux Markets team, helping Tom kind of manage the business, manage the team.
Fantastic experience, thank you. What then, though, is the hedging show all about? Let me enlighten you. Each week, we aim to dive a little deeper into a different segment of the oil market and talk about recent dynamics. So in the next 30 minutes or so, we'll be having a look at how the latest market news and industry trends are impacting prices, how it all impacts relevant industry and business, and we'll be bringing you expert advice too on how to structure a hedge using derivatives. A lot to cover off then, time to get stuck in. Let me ask you firstly then, Tom, if we may, can we just have a look at refinery margins? Bring us up to speed with the latest picture.
So it's been a kind of recurring theme really since the summer. Refinery margins have been very strong, so mainly being driven by gasoline and gas oil. And we kind of think of the refinery margins are essentially the cracks, which is like the differential between the refined product and the output essentially, and the crude oil, which is the input. Higher cracks basically mean that there's a higher refinery margin because those refined products are worth more relatively than the oil that's being used to produce them. That's been a kind of long-standing theme really, hasn't it, since the summer, Harry?
Yeah, I mean, usually you would expect things to kind of cool down a bit in the winter. But yeah, as we've seen, when we look at margins, we talk about kind of our internal data that we have on the indices that we have. But yeah, it's just been a kind of continuous rally since the summer. Suggests like a kind of relatively distressed market. But yeah, I mean, we haven't really seen on our indices anyway, we haven't kind of seen these levels on a sort of seasonal basis for about 2 years. In fact, not even on a seasonal basis, just on an outright basis for around 2 years. So yeah, seasonally very strong and even just outright very strong as well.
We can see that on your own data and chart here.
Yeah, exactly. I mean, yeah, you can see since kind of, well, even the start of the chart, it's just kind of completely blown out, and quite uncharacteristically, a lot of this move has been driven by gasoline, which tends to kind of peak in the summer and then kind of cool off in the winter. And distillate's been a huge contributor to this as well, which is, I mean, it's a very kind of outsized move, but more kind of expected in the winter. But yeah, the gasoline strength has been, yeah, kind of completely unprecedented.
We're seeing kind of crack levels in December and January that you'd normally expect to see during the summer months.
During a strong summer month, yeah. I mean, I think even just to give some context, so the crack spread between the European gasoline and the Brent, anytime in the winter, kind of double figures in that is very high, and we're kind of pricing at the moment. I think in the November month, it's pricing kind of north of 20. So sort of double what you might expect.
Goodness. So let's explore that a bit further then, if we may. If we speak specifically about gasoline, gas oil cracks, just tell us a bit more about why they are so high at the moment, and do you see them settling down?
Well, why they're so high? So gasoline is in a kind of regime at the moment where you've got very tight global stocks. There's been a lot of refinery outages. There's refinery maintenance, which tends to take place at this time of year because traditionally the market is not very strong and demand is not that high. So it's a good time kind of cooling off from peak summer. So good time to do maintenance in the refinery. That's not the case at the moment. So yeah, you've got a very strong physical market, like a very low global stocks, and just a lot of kind of issues with refineries around the globe. I mean, the Dangote refinery in Nigeria, so that came online in recent years, and yeah, that was kind of seen to give some relief to the West African gasoline market, and a lot of that gasoline usually comes from Europe. So actually, ironically, the opening of that refinery, the gasoline traders in Europe were a bit worried, like, what are we going to do with all our product? We're just going to be swimming in product because we're not going to have anywhere to send it. And there was kind of, talk that the gasoline market would just be kind of in this like weak regime forever. But
that's been sort of beset by constant problems and outages, hasn't it?
Yeah, it's just one thing after another. So I think no one seems to be able to rely on it. Some of their units have been down for a long time. So yeah, it's just like a bit of a perfect storm for gasoline at the moment. And then gas oil. I mean, that's just been in a kind of like perma bull market. I mean, it's been marred by similar issues with the refineries.
They've been running kind of full pelt since the summer, so there's been kind of no maintenance taking place because margins have been so high. So then that's been leading to kind of higher outages, general kind of tightness that we've been talking about since the summer. And then you kind of expect a bit of strength seasonally with gas oil, but even so, it's kind of elevated, and it's like a similar sort of perfect storm scenario, really, isn't it?
Yeah, and then gas oil as well has been hit a lot by the sort of Western sanctions on Russia, because Russia was traditionally like a big exporter of diesel and still kind of has been supplying the East with products. So it's all kind of competing globally. So those sanctions bite, and then the global market gets tighter, and then any kind of refinery maintenance that has taken place is cutting off supply and outages, and it really is a bit of a perfect storm at the moment.
And we've got two charts to illustrate that.
They all look quite similar just because they're all kind of driving one another. So the kind of the EBOB crack, which is the kind of European gasoline versus Brent. This is the chart for the December contract. I mean, like, if you kind of picked any contract, it would basically show the same thing. It's just been kind of one way
rallying, hasn't it? And then they've been getting particularly strong as they go into the pricing month, haven't they? They've just been sort of really kind of
and kind of very recently, sort of more this week, there's been a bit of a consolidation, which you can maybe see. It's just kind of cooling off a little bit,
come off the highs a little bit.
I mean, seasonally these levels are just kind of unprecedented. Anything that's kind of above $10 in the December contract or any kind of winter contract would be very seasonally strong. So we're kind of above and beyond any sort of normality.
Indeed. And we've got a gas oil chart as well. Just take us through that one.
So here we've got a graph of the gas oil flat price. So that's the outright price in dollars per ton rather than the crack. But you can see here, sort of since the middle of last month, there's been a tremendous rally from about $620 a ton all the way up to $735 a ton. So that's a massive rally, which is probably going to add 6-7p a litre to pump prices.
And the drivers of that rally must have been something like sanctions.
So this sharp move up here was all sanctions driven, and then it's really just kind of kept going, albeit a little bit more steadily. And then just in the last kind of week or so, there's been a lot of talk about the cold weather snap hitting the northern hemisphere. So that's just kind of added even more strength, really. So I mean, I've said it, but we've been saying it since the summer, but it's a perfect storm, really, of kind of factors.
I think what you've seen on gas oil specifically as well is some of the kind of large traders and funds were positioned quite short. So during these moves, they kind of get exacerbated by people stopping out. There was a lot of kind of speculative short just on how high the outright levels were. And then a lot of these moves have just been made so much worse because everyone's just trying to cover their shorts and kind of stop out, basically.
Is it worth just exploring the point you made, which I thought was a brilliant point, about maintenance levels by some of these refiners? Has that, taken you guys by surprise or not?
Well, not really. I mean, it's kind of expected, but it's hard because they don't really know they just assume the conditions are going to be, favorable to do maintenance. But I mean, it's not always that easy to find out as well what they're doing. I mean, they can kind of cancel maintenance. You get last minute maintenance, unplanned outages.
It sounds like it's a really important thing that they have to do, though.
Yeah, it is. But I suppose they kind of have to make a call whether, how critical is it versus our profits? I mean, can we kick this down the road for another 6 months?
And then there's an element of luck there, really, isn't there? You're probably only really going to find out about it when it results in an outage.
Yeah, and they might try and scale it back as well to not affect some of the units that are producing the high value products. So it's not like they just kind of cancel it altogether. They might just say, let's do this, but not that. But in some cases, they say like we have to do it. It's not like totally optional. It's just if there's any kind of flexibility there, you're going to try and exercise it.
Or if there's a massive fire.
Yeah.
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 So what does this strength mean then, do you think, for refiners, say like Phillips 66 or Shell?
Well, if they have the flexibility to run and max out their capacity, then they absolutely will and should be doing that from a profit point of view. I mean, especially this time of year, it's just, from an opportunistic perspective, like they would never be this profitable in the winter since the kind of war times when product prices were just crazy. So yeah, I mean, if they can delay maintenance or kind of taper down maintenance, then they probably will be doing it, because they're just going to be in this like insanely high profitability situation if they like are able to exercise extra capacity and whatever.
And then so worth mentioning as well that gasoline's a blended product, so the other blending inputs as well are going to be seeing sort of similar strength. There's going to be high demand for those, and because of this higher output, there's also going to be a higher demand for hedging as well, because the more product, I guess, being produced seasonally, and also kind of greater appetite to lock in these higher margins by hedging.
Well, just on that note, what would we expect, you think, in terms of hedging activity moving forwards from that strength?
Well, so I think kind of unlike some of the other products or industries that we've covered previously, I think the kind of refineries hedging is a little bit more opportunistic. So they're going to want to only lock in margins when they're high, but they might have been doing this incrementally as the market's been moving up. But in a weak market, there's no point in them hedging. They'll probably just scale back their output. In a really strong bull market like this, they'll hedge as much as they can at these higher levels, but they might have already hedged some or all of it. But they'll be also ramping up production as much as possible. But ultimately, there is a ceiling. They can't just go on, producing more and more forever. So yeah, we would expect higher volumes being produced and that leading to higher hedging volumes, I think.
Yeah, but it is an important point to stress that they can't be as opportunistic all the time, as in they have committed to certain hedges at certain levels, which will be really profitable for them. But they kind of hope that, I suppose, if they can add extra capacity, run more crude, then it gives them more product, which is unhedged, that they can be kind of making that the bigger margin. But generally, you just would expect activity to be high, like across physical and paper markets, just with the sheer volume that you're seeing.
Yeah, vary massively as well.
Absolutely.
Yeah, so you never really know what each refiner's kind of plan is or how they do it, because they all do it differently, and even within the teams, they can exercise a lot of discretion. So, but yeah, you would expect it would be silly for them to not be trying to lock in these levels if they can produce more to go with it.
And yeah, also worth pointing out that the higher run rates are going to be leading to a higher output of the waste products as well. So things like kind of naphtha, high sulfur fuel oil, and I think firms are generally kind of much more keen to hedge out those, aren't they? Because they're just deemed as sort of waste products. They're a kind of cost to the business.
Yeah, they're kind of net unprofitable parts of the barrel. So the fuel oil, high sulfur fuel cracks, and the naphtha cracks at the moment anyway are negative. So kind of you lose money processing, but it's part of the refineries that this product just gets produced. So what you've kind of seen recently, and while these gasoline and gas oil cracks have been doing really well, is that the high sulfur fuel cracks have actually been weakening, and that is often the case because the refiners have no choice but to produce this as a byproduct. So they want to kind of cap their losses, so they're often quite keen to hedge these, like Tom said, these waste products like naphtha and fuels.
At this point, just explain to us, guys, if you would, why it's important for refiners to hedge. What's the benefit?
Well, I guess ultimately it is to protect margins, isn't it? Like lots of these firms are operating on fairly tight margins, and they just want some kind of stability in their kind of future forecasting. And we've seen when you get up those graphs of the the day-to-day price action, you just want to insulate your business from that kind of roller coaster of sort of market forces. And if you've got an opportunity like you have at the moment to lock in high margins, then why wouldn't you? It's a bit of a no-brainer, really, isn't it?
Yeah, because you're also having to kind of commit to like forward purchases of crude to run through the refinery, forward sales of products. So if you don't have the predictability of margins, you're just really like running the gauntlet basically in terms of profits. And yeah, it's like your cash flow is going to be all over the place.
And do most of them, you're so experienced that, and we know that. So in your experience, do most of them act differently in different situations?
Not massively. I mean, there's some, I guess, like that you have the kind of conservative companies who will just be very like methodical about it, and the sort of more like opportunistic companies who, they have more of a sort of risk-on approach to like, a risk-on approach to kind of the management of this stuff. They would say it's hedging, but often they'll exercise a lot of kind of speculative discretion on it. So, I mean, to the letter of the law, if they're not hedged 100%, I mean, it's 100% of what? Because it's all kind of forward, you're just sort of guessing what you're going to be producing to a certain extent. But a lot of them will have like a range in which they will hedge in, and the traders will have a discretion how kind of hedged they want to be, basis like where they see that margin as being kind of profitable for the refinery. But yeah, I mean, you definitely have the kind of conservative companies, which might be the more like kind of public companies, like BP and Shell, who might have a more, like I say, conservative approach, and then the more kind of risk-on companies who are happy to sort of run a bit more risk in terms of their like cash flows, profits, whatever.
Yeah, I think you can sort of stomach a bit more of that sort of P&L volatility, can't you? If you're a private company, you're not accountable to shareholders.
Yeah, pretty much, yeah.
So say for any new viewers then tuning our way, how can refiners, do you think, construct a hedge with Flux markets?
Well, so I think that, the most obvious way is we're offering, EBOB cracks. So EBOB is European gasoline. We're offering gas oil cracks. So that's the type of product a European refiner would be attracted to. But, if we've got refiners operating in the Middle East or Singapore, we can also offer the local benchmarks there. And we can also offer those cracks versus either Brent or Dubai crude.
Absolutely, yeah.
And yeah, we offer, a wide range of products, a wide range of tenors. So, you can do the very prompt stuff. So up to, current month, or you can go out to the, for the next 12 months, 18 months. We can offer quarterly contracts, calendar contracts. There's a high degree of flexibility, really.
Yeah, and even, some refineries kind of act as like one team where they'll hedge the kind of crack spreads as one, and we can offer all the contracts up and down the curve for that. We can also facilitate contracts if the refinery is split into kind of individual teams. So if the crude team is managing the crude, the gasoline team is managing the gasoline, we can offer the flat price contracts, time spreads, the DFLs on crude, and the flat price spreads, cracks on gasoline as well to help. And we can offer the flat price contracts to help with inventory management. To all the kind of different facets of the risk management process of the refinery, we have thought about, and we are offering contracts to kind of complement that.
So lots of refineries have also diversified out into biofuels as well now. And, biofuels, as we've spoken about on previous episodes, are a component of the fuel that you buy at the pump. So things like FAME, RME, HVO, and we can also offer pricing and liquidity on those products as well. So kind of, huge sort of versatility in the products that we've got on offer. And, we've got a lot of expertise here in helping our clients construct those hedges and, work out the most effective way to deploy their capital and kind of, hedge against price volatility to protect their businesses.
Harry, I bet you go along with that. It's a good offer.
Yeah, it's a great offer. And I think like where we've seen clients get loads of value in the past and recently is using us as kind of a sort of outsourced part of their team to help them construct hedges, because it's confusing. They're happy to share their physical exposure with us. They trust us to kind of work through it properly, and yeah, we can kind of come up with a plan with them that works for them, like Tom said, the most efficient way to hedge, which is not always obvious to them.
Tom, Harry, thank you so much for your input for today's session, and of course thanks to you hugely for joining us. Do it all again. That's it for today's session, but join us again though next week for another episode of The Hedging Show. To remember, you can get involved as well, Please do email in any questions or topics you would like us to discuss. Head to flux.live or freemium. Bye for now.
Hello and welcome. This is the first and the only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar. It's all here in the next 30 minutes. On the show this week, will COP30 actually achieve anything? We report on some nascent plans to create a roadmap for the world to abandon fossil fuels. The UK Energy Secretary Ed Miliband saying it can be done. Ukraine is hitting more and more of Moscow's oil refineries. The price of Putin's oil is falling. What will that mean for UK fuel prices? Are they going to come down? And North Wales will become a beacon in the golden age of nuclear, says the government. Plans are announced for the UK's first ever small modular nuclear reactors. They're being built by the publicly owned Great British Energy. Joining me now to discuss the week's events, Greg Newman, the Chief Executive Officer of Onyx Capital Group, and Julian Keyes from Flux Markets. Gentlemen, you're very welcome. Shall we start with COP30 and see what's going on there? As we get towards the end of the conference, the negotiating becomes a little more fraught, and the question hangs in the air as to whether anything of substance can be agreed. However, there is some optimism around a consensus on language about a roadmap for all countries to stop using fossil fuels. At a press conference on November 18, a spokesman for the French pressure group, Oil Change International, was in combative mood.
If we are to have a roadmap on fossil fuels at this COP that is useful, that is actually helping countries to transition to renewable energy and to full energy access, we need it to, first of all, be rooted in equity. So we need this process to grapple with the complicated question of who is going to phase out fossil fuels when. And not countries are going to be responsible for the same timelines. The second is we need to look at the enabling conditions, because we can say fossil fuel phase out until we're blue in the face. But if we don't look at what's preventing a number of countries from getting out of fossil fuels, that's going to be for nothing. So we need to look at the finance. We need to look at the technologies. We need to look at the just transition. And this is part of the package. If there isn't progress in these negotiations on finance, in particular on just transition, on adaptation, a lot of countries will find it exceedingly difficult to agree to fossil fuel language. So let's not just look at the fossil fuel bit in isolation, but as part of a package for justice and for equity.
So a low-key preamble to COP30. It might be that a deal on this roadmap is possible, but the money, of course, will matter. Which countries contribute and just how much? How's your level of optimism, Greg? COP30 going to achieve anything, or is it going to go down to the wire as ever?
I think at least the Western nations, they're up against it because, of course, the US are so aggressively against the carbon emission narrative or cutting carbon emission narrative. And I think the CBAM, the carbon border adjustment mechanism coming in next year, I'd be very surprised if that doesn't come up, because that is, or if it doesn't come up, and there are some discussions around how to essentially raise more money for this, for UK to spend more money. I think the immediate political backlash would be like, and on top of that, we've got this carbon adjustment coming up next year, which is going to be very inflationary. So I think it's going to be very difficult. But I still think Ed Miliband will continue to be very positive about it. But I think when he gets home, he's going to be under the cosh, because as soon as people start to realize that things are going to get worse and worse from a cost perspective, I don't see how that's not backlash. But generic point of view, I guess.
The whole point of these conferences, June, I suppose, people do get carried along with the sort of groupthink that's prevailing at the time. As Greg was saying, the risk is you agree to something that's not practical or not possible or not doable.
Yeah, that's a really good point, and I agree. Affordability is on everyone's mind at the moment, right? This is why Donald Trump's not engaging with this, because affordability is right on the agenda, as he's finding out at the moment. So it's really important. I think you're right, Greg. Ed's going to come out with very positive things. In fact, he said that it is achievable with will and ambitiously within the next 10 years, yet to be seen. I think, having sat on this podcast for 3-4 weeks, it is so important to understand your electorate's appetite the change in cost. And right now that's nil. So it is going to be tricky. Last COP meeting, Azerbaijan last year, the countries agreed to put 1.3 trillion into the pot. So this time, the roadmap, this COP30, the output should be how are we going to mobilise and operationalise that. And I understand that is the focus, as we saw from the French oil change. I've forgotten his name. It is about equitability. It is about how we're going to unlock and operationalise this process, and that is tricky. I don't know the answer.
Who knows? We may still be talking about this next week because these things often overrun, don't they? Next, more information about the Ukrainian attacks on Russian infrastructure. Reuters is reporting this week that the Ryazan refinery, that's one of Russia's largest, has stopped a key processing unit. Elsewhere, Ukrainian hostility is impacting on the availability and the price of Russian fuel. But I suppose we have to wonder, what does that all mean for us in the UK? What's the latest market news as we record, Greg, on the Russian numbers?
Well, there's the Russian numbers, and then there's the diesel that they export, which is what I think is much more important for the UK to be aware of. So the price is actually very ambiguous. Bloomberg have reported the prices being lower, $23 around that discount to Brent, which is an almighty discount, and it is low. But to be honest, if you actually look at how prices have risen throughout, slightly risen, it's not a huge impact from where we are, in my opinion. But of course, every dollar counts type thing. But on the flip side, we've had a very aggressive rally, as we call it, an increase in price in the heating oil and the diesel markets, which are very tightly linked. So that's on a relentless rise. I think gas oil is about $800 per metric ton. So that's quite a significant increase. And I think that is I know it's going to lead to higher prices in the UK very soon. It's just whether or not it really goes for it, because you can see the Brent price and like the Russian price, like you just said, there's a headline prices and they can get reported, but you've really got to look at the diesel price, the outright price, and that can divorce quite aggressively from these headline prices, which it is. So bad because prices are actually increasing for us.
It's going to go up. Yeah. And of course, as we record today, we haven't seen the effects of the latest American sanctions against Russia. They've still got to be factored in sort of starting next week, right?
Yeah, they actually come into full impact on the 21st, so Friday this week, if my maths is right. And I think, just to reiterate, it is very asymmetric. So, yeah, the crude from Russia is trading at this substantial discount. To the casual buyer, they might think, well, that's going to impact my buy diesel cheaper. But actually, we've seen, and looking at the graph here, we've got diesel prices here in the UK. They have significantly rallied towards the end of last week as a result. So we got up to, this is all in pence per litre. So this is £1.51 at the moment. And during the course of last week, we're £1.47. This is pump price, our recorded Flux pump price.
So you will see this in a couple of weeks at the pump, right?
Exactly. It takes, so if prices stay at this same level or go higher, we'll see that lag as people buy new stocks at their local forecourt. At current prevailing prices, this filter through, because it takes somewhere between 10 days and 3 weeks to filter through.
But the buses fill up today, right?
Yes. And
as you see this program.
And I think we need to also underline, and we've spoken about it before, that yes, Russian crude has decreased, but if sanctions are really policed rigorously, and I mean sort of second level, that in the past, Russia and other countries that have been sanctioned work around these. They've got ways of obviating it, right? If that's not possible, we really will see these prices and oil prices go up quite
That's what I was
substantially.
going to add to this. So it's been a strange couple of weeks for the market because the sanctions got announced, and as Julian is describing, that is undeniably for the freely market traded oil is very bullish. We expect the prices to rise very aggressively. There's a lot of messing around. It was a big shock to the oil market, and actually the oil market participants generally, the traders, didn't fare very well. But now that's kind of coming to an end, and we've had bits of overhang, bits of glut, people talking about this and that. When they bite next week, the reality is going to bite in combination with diesel. It really is, the global market, his eyes are on diesel, and sanctions will start to bite from next week. And it could get not just bad, it could get very, very, very bad. This is like 2022 levels. It's going to be very hard for people to understand because they say, isn't there so much oil around the world? It's like, yes, but you're talking about a very
It's like perverse, isn't it?
It's very
There's a lot of oil around, but the prices are still going up.
And what you're going to see more of is as the prices rise, as we do, quite high conviction expect, you're going to get governments doing what they do in these scenarios like they did in 2022 and start to try and pull levers. So they might be saying, look, we can release some of our strategic petroleum reserve. And that's what the US did in 2022. They released 1 million barrels per day. But the thing is, they've done that and they didn't replenish it. So if they do it even more now.
So not a trick they can repeat.
It's not really a trick, or they could, but it just puts them under a hell of a lot of pressure.
Yeah.
And I think my personal view is, and this is hugely conjecture, but Trump's relationship with Saudi Arabia, he's always had a good relationship with them and encouraged trade. But I think you never know what's going on behind the scenes. And I think he's always been aware that if I'm going to put more pressure on Russia, I need cooperation with Saudi Arabia. But he's not an oil trader. I think he overestimates how much they can supply in lieu of Russian oil. I've stopped buying Russia, just buy Saudi. Saudi don't have that kind of spare capacity.
It's not that simple, is it?
Really not that simple. And even weirder than that, there's even for the US, who have quite a lot of excess, even they need to import some of Saudi because of the grade and things like that. So it's going to be a bit of a mess, we predict. And with these things, the most worrying part is every time we do something to Russia, it just makes it worse. But I think even if it was to make it better, I don't see them as a country or who can come to a negotiation table and within a couple of hours it's done. This is a negotiation that even if it's successful because of the sanction pressure, it will be years before something's negotiated. So I don't see a world where oil is not incredibly tight and highly priced, unfortunately, going forward.
Okay, let's talk about wind for a second. As we record this programme, Wednesday, 19th of November, we've heard this morning from the Chief Executive of Great British Energy, one of his first appearances, before the Scottish Affairs Committee in Parliament. Here's Dan McGrail being asked about the achievements of his new organisation.
I think it's a very positive, from an individual perspective, I think it's a positive idea to give people a stake in the energy transition. And from an energy sector professional perspective, I see the benefit of having an activist public investor to work alongside the private sector. And I think key for us has been to develop a strategy and engage with the market so that we can target how we are additional in our strategy and build it up. In terms of our first accomplishments and over the sort of the past year since the company was incorporated, the bill was passed in May. The statement of strategic priorities was published in September. So we've made good progress. Obviously appointed a startup board, permanent chief executive. We've launched the solar rollout on schools and hospitals. And today we are announcing also, purely coincidentally, our first investment, which is into a floating offshore wind farm off the coast of Caithness in Scotland. And we're doing that together with the National Wealth Fund and the Scottish National Investment Bank.
So a first project for GBE coming along, though he does admit that in terms of wind projects, there are no indigenous British companies to favour. Of course, government authorities are always under pressure to try and give work to British people if you can. Making of wind, the construction of wind farms, it's all done by other people, isn't it? Including the Chinese.
Yes, yes. I think we do have a lot of technology and industry. From what I've read, I can't respond to that directly, but I understand that we have 100, 200,000 jobs related to the renewable revolution that's built over the last sort of 10 years or so. But yes, to your comment, a lot of the infrastructure, the battery is related to China. And
there I had some other political worries about it.
Yeah, absolutely. And so it does can turn on its head the sort of idea of complete energy security.
Yeah.
Right?
On a broader point, Greg, this great British energy idea, it's an idea the Labour government brought in. Are you sceptical? Do you think it could work, or do you have your doubts?
Well, since the beginning, when we talked, we didn't really understand what they were going to do. And I still don't really understand what they're going to do. But I guess it's like they're kind of trying to guide the process. Is that the general philosophy of it? I mean,
yeah, an overall sort of providing energy, providing money, providing coordination, I guess, to get stuff done. That seems to be the ethos, anyway.
Yeah, I think it's about providing liquidity through public and also corporate finance. So both. And if they need to step in, I don't think it's about taxpayer funding. The idea here is to sort of get like PFI, that old sort of private finance initiative, redirecting investment into that directed. So, that's what it's about as I understand it. But yes, we need to see it operationalized, and we haven't yet really seen this. We're just starting to see it now, which is really good.
All right. Well, that's all that's happening this week. Any more charts for us at this stage, Jim? What have you got for us in terms of what's moving on the prices market?
Yeah, absolutely. We did just quickly look at the flat price, the outright price of pump diesel. In terms of what's really driving that, if we look at this chart, it looks almost identical, but it's really the difference between the cost of diesel and crude oil, the cost to refine crude oil into diesel, as traders call it, the crack spread. And that has really moved in reaction to the shutdown of some of the eastern refineries that are owned by Lukoil, and also this lack of up to 3 million barrels a day coming out of Russia that was coming onto the market. That's putting more pressure on that system. So, this is filtering through, as we saw in the previous chart, into pump price and diesel price and also gasoline prices. And just quickly, as Greg mentioned just now, if we look at that top left-hand, number, that 144, that's the government price published today. The average pump price across the United Kingdom, so £1.44 pump price, and we're seeing prices here in our table here at the moment at about £1.53. So if prices stay at this level or go higher, pump prices will react. Tends to take 10 to 2 to 3 weeks for this to filter through. So 1 to 3 weeks to filter through.
Okay, Julian, thank you for that. This is the UK Energy Show, brought to you by Flux, the biggest news, information and trading platform for world energy markets, from Onyx Capital Group. Now, next, something brand new for Wales was confirmed by the government this week.
For decades, Wales led the way in powering Britain, and today we're leading again.
Right here in North Wales, we're building the UK's first small modular reactors, the start of a new golden age of clean energy.
Thousands of high-quality jobs, new apprenticeships, billions of pounds of investment delivered by Labour government in Cardiff and Westminster, working hand in hand.
Wales will be at the heart of our mission to make Britain a clean energy superpower.
This is the power of Labour working together, delivering energy security, good jobs and a brighter future for every part of Wales.
Now, the government argues these small modular reactors will be an important part of the electricity generation mix. Others are not convinced. A campaign group called Nuclear Free Local Authorities says that SMRs are uncertain and unproven, and that power generation, in any case, from these things won't start until the 2030s. Oh, and by the way, the electricity created will be far more expensive than that generated from renewables. So, your take, gents, on small nuclear reactors, modular reactors. Are they going to work?
But I think anything that at least attempts to reduce the intermittency of renewables, just basically wind doesn't blow all the time. It creates a strain on the grid because when the wind doesn't blow, they have to go and use natural gas. The natural gas traders go, thanks very much, rack up the price, and we end up paying way more. So anything that more reliably supplies the grid that isn't fossil fuels, that isn't in the hands of traders, should be a good thing. Obviously, this is an easy thing to say, but we should have had these a long time ago. So it's one of those things where you say it won't be done in 2030 till 2030, but that's probably what they said in 1990. I don't know. So I disagree with that logic. I think we need as much as we can. We need as much reliability as we can. We've seen the impact of Germany reducing their nuclear, and it increases your reliance on the excess, even coal. So you just need to be very, very careful about saying nuclear is not needed because we have renewables. But what renewables? Do you agree with that?
Yeah, I do. I think nuclear is a renewable. Problem comes when you come to decommission it, of course. I think we've got a long history globally of building nuclear reactors on a larger scale. What I like about small modular reactors is that they are more flexible. You can deploy, the idea will be you'll be able to deploy them around the grid, just, wherever you really need to build it relatively quickly. This is about baseload. This is about continuous consumption. So it's not about helping at tea time when prices really ramp up. That's not about switching on there. We will still need gas or short to medium long-term storage that could be switched on at that time. And there are answers within the renewable sector to that. In terms of expense, what I understand from what I've read, I don't know, and it is a bit hypothetical, this is going to cost about 5 to 7 pence a kilowatt hour. So, today, if I go and fix my electricity price, I'm paying 26p. So it is cheaper from what I've read, theoretically. And I understand, again, theoretically, it is easier to decommission than the larger nuclear reactors. So to my money, it's a good thing. And it's in Wales, so that's supporting Wales and jobs.
I thought you were going to say something else there.
No!
Well, Hartlepool have got some developments away. They are coming around the United Kingdom, but I think this is the first for Wales.
Yeah,
and
absolutely.
Going up on
Good
Anglesey,
stuff.
I think, and there may well be others too. This is the UK Energy Show. Next, what's being talked about on social media? All right, a couple of things we're going to talk about. ExxonMobil, very much in the focus. Ed Conway, first of all, posted about this. Sky's economics guru, of course. They noting that the Exxon people are closing the plastics factory in Mossmoran, losing some 400 jobs. Well, a person, maybe a man, maybe a woman, called Big Orin, says, hope the government force Exxon to either sell the plant or clean up and demolish it before handing the land back to the local council. Exxon coming in for a bit of grief there, Greg.
Yeah, I think his comment. I understand completely what he's saying. Isn't like, and now it's gone. Let's clean it up. Great, but I think I'm actually more interested in what he's commenting on, which is the plastics refinery going down. And I love that this guy was saying, the UK invented polyethylene, and now we no longer manufacture it, no longer export it. That's just an unfortunate reality, which is you lose your competitive advantage. Obviously, the economics don't work; you can't do it. But to be clear, people are going to say, oh, we've lost that to China. Well, we actually haven't. We lost it to the US. The US export an incredible amount of natural gas liquids and petrochemicals to some extent, and or at least the feedstock for these petrochemicals. So we were taking that in at very cheap rates, and we were processing it like INEOS, that kind of thing, and we're just doing it less and less because we can't do that as efficiently, and global prices and all that. But if we had been sourcing our natural gas liquids more directly, if we've been supporting that industry, and if we'd had better tax situations, you never know. This could still be a burgeoning industry, and clearly we have the expertise.
We've shot ourselves in the foot with this one, do you think?
And it's just yet another sign that that's exactly what we've done. Right. And it is what it is. But you're just going to hear more and more of these stories, and we hear them all the time. But it's just a steady decline, which is almost inevitable now to be dead unless there's a completely big reversal. That's my take.
Yeah, for me, it's a dreadful shame that people are losing their jobs. Hopefully that they can retrain and go into other areas. I think it's really important that, we think about, it's clear that people feel very strongly when things are in their backyard about pollution, environment. But of course, what we need to think here is that with the loss of that revenue, we're losing tax receipts as well, right? So, at a time where affordability, both individually and as a collective, public finances are poor. So, these things all have knock-on impacts that we then need to pay for. So it's not simple, it's not straightforward, and unfortunately it's down to economics.
Comment here from another one about ExxonMobil, actually, because there's a report that they're considering buying some of Lukoil's international assets. This has come from a post on X from Strictly Oil and Gas member. Assets in Kazakhstan and Iraq under review. What do we think the Lukoil situation is?
Yeah, it's really interesting because this is an oil trader, right? Sometimes people, I think a lot of people aren't aware that they know of the big producers, but they produce it and kind of stand still in a way, right? The oil traders have to come in, take it from them, deliver it around the world to refiners and that kind of thing. So really the oil traders are incredibly important to our ecosystem of oil and gas. So people are very keen to get after Lukoil's assets because they were responsible for delivering a hell of a lot of oil to the world. And something in Iraq, I think, are they talking about the one in Iraq? Yeah, Iraq and Kazakhstan. So Iraq's the big one. And there was talks of Gunvor, which is the Geneva-based oil trader, taking over. And then quite amazingly, the US came out and said the Gunvor is just the puppet of the Kremlin. And, a very controversial statement to make. And I was speaking to people who work there.
Yeah.
And, 1 minute they were saying, oh, this is great, we're going to get Lukoil's assets, there's more to trade, there's more to do. Next minute, I'm like, well, what does that mean? Like, suddenly hero to zero type thing. And it's pretty amazing that they came out with a statement like that. And it is, we have these rumors all the time about Gunvor, who are they really owned by, that kind of stuff. But, I don't think there's much evidence of it. But either way, it was remarkable. But it does show you that just because a country produces oil, you got to remember that oil traders are the ones that really do all the work to get the oil. So I think it's an example of how the Trump administration hasn't just generically looked at oil like maybe they have done in the past. They've gone and looked secondary, tertiary, and all the way down the chain to sanction and get more and more of a tighter grip. And that's another example.
This one alludes to, we'll finally do one from a guy called Paul Rainford. It kind of alludes to the COP30 conversation we were having. And it's a familiar argument, this about, why are we doing something when we are a relatively small producer of CO2? And the argument is presented by Paul. He cites this graph. Our world in data is the graph he's alluding to here. And China, of course, produces an awful lot more CO2 than the rest of us put together.
I quite like how he's put it. So glad our bills are very high so we could save the planet more on. Yeah, I mean, like that is a pretty leading argument, right? Like we are trying to, the narrative is we're trying to lead. So we're saying, look, this is how it should be done and everyone should follow. Unfortunately, another narrative, which if you listen to some of the major podcasts and around the world, you hear the Chinese diplomats, they are aggressively saying UK is dead, it's a waste of time. Yeah. So they're not leaders. So then if you're not a leader, then you're just doing it for the moral high ground, which, the UK are known for doing, right? I mean, there's people who will do what's right if they think it's right. And I've always said, and I think that's the point of this show, it's a democracy. If that's what you want to do, that's what you want to do. But you do need to be aware it's having this impact relative to China and it's costing you this much relative to people who are actually making money. If you're still okay with that, that's absolutely fine. But at least you know.
Okay, we're going to be talking a lot about money in the next 7 days or so, because about a week's time from now, we'll be putting together the UK Energy Show just as the Chancellor will be delivering her second budget in the House of Commons. So many rumours and guesses and kites being flown over the last few weeks. Personally, I've never seen anything like it. So, Greg and Julian, I wondered if we could just have a look at some of these things and maybe you could score them as to whether you think the rumours are likely or not. Here's one idea. Let's cut the VAT on domestic fuel, either gas or electric or both. What do you reckon? Likely, unlikely?
VAT, I think it's a possibility, definitely under review. But let's think this is a Labour government and that is a very progressive tax, right? So if have a large house, a mansion in
I'm going to say thank you, aren't I?
I'm going to say thank you very much indeed. I've just saved myself a much bigger proportion of tax. Yeah. Whereas if I'm a small maisonette with a very low consumption, this 5% in absolute terms is relatively little. So percentage-wise, the same for everyone, but in absolute terms, much bigger impact for larger homes. So I think it's possible. And I think they need to really think how they structure it carefully.
There was an interesting report, wasn't there, from the Joseph Rowntree Foundation, which you sent me on a text message, which I hadn't spotted actually, which is suggesting something a bit different. Don't do that, but actually do some banding where the first bit of electricity, that's quantity you consume, is set at a lower price, maybe with government subsidy to achieve that. So low users or low income households benefit, but then make it progressively more expensive.
In fact,
your income tax, I suppose, you have bands.
I think absolutely. So you're trying to support that Joseph Rowntree piece that came out yesterday. In fact, that is about weighting the average consumption cost across the market, saying very heavy consumers pay a higher price, and they're paying and subsidising, not the government, but those heavy users subsidising the lower, smaller consumers. So you're averaging that price. But again, it needs to be thought through really, and this is where policy is so dangerous. That sounds like a great idea, but what happens if I've already sort of invested in a battery in my home, so I'm consuming a lot at night and not during the day.
Can I cut in?
Of course you
Because that's a really leading point for me, because it's devil's in the details. They said fuel, right?
Absolutely.
The rumor is fuel.
Absolutely.
We say electricity. I think if you read between the lines, so you've got COP going on, you've got VAT being mentioned to cut, and you've got prices rising, and they probably know prices are going to keep rising with the sanctions. They also know that the carbon border adjustment mechanism is coming in. That is going to make gasoline and diesel more expensive if they import it. Why not cut the VAT? Because they know those things are coming, and they're probably going to get more tax anyway. And the final thing is, Rachel Reeves was reported to have reported to the Competitive Markets Authority recently to say we need to see more visibility on the forecourts, and it needs to be a live data set. They want to see a live data set of pump prices around the UK, so that can go to apps like Waze, Google, and then Onyx's app, which you're going to see.
Yes.
and the point is to increase competition and to try and lower prices
with real-time data.
So I think it's very interesting that she's targeting gasoline and diesel after never not mentioning it at all. And suddenly it's around this time, and it's around the Russian sanction. It's very much about all of a sudden. So I think it is quite likely, and this is completely speculative.
Sorry, but we're confusing two issues here. That's VAT on electricity bills.
I thought the rumor was on fuel.
I'm not sure.
Well, that's what I'm
could
saying.
be.
There's been a
But actually,
rumor been
what I
discussed.
do know that they're thinking about doing is the duty was reduced during COVID by 5p.
Yeah.
Okay, excise duty on fuel was reduced to 53p, just under 53p. It used to be 59p. That is highly likely not to be renewed, that short-term discount. So I think come April,
so it's taken
we'll see
away.
duty go up on fuel, on gasoline and diesel.
But VAT
it may not
maybe.
be immediate because of what does the government also not want interest rates going up?
Well, exactly. I mean, who knows? And while we're just doing one more who knows, vehicle excise duty on electric cars. This seems an inevitability, doesn't it? If you've invested in an EV, you have had the benefit of almost no road charge at all, or smaller ones. The time has come, as I suppose the proportion of drivers changes, nationally speaking, you're going to have to put some tax on them, aren't you?
We don't have a little magic elf with a wallet paying everyone, right?
We don't.
So we need to fund that somehow. You can't continue with that process. So absolutely. And I think they changed something earlier this year, didn't they? So you have to pay road tax now. The more expensive the car, if it's over 40 grand, every EV is over 40 grand, I think. So that came in, and absolutely you need also above and beyond that, 53p or 59p duty on gasoline and diesel. You can't get that on an EV. So you need a pence per mile fee for how much you drive.
Which opens up the whole road charging by mile debate, doesn't it? Really?
Absolutely. So I think we've got, watch this space. We don't know what's coming, but things are going to change.
It's fun to look though, isn't it, really?
Yes,
We'll know
yes, absolutely.
But I do think it's worth saying that you put it quite well. Whatever they do, they're looking for more money. If they can reduce things and get some political wins that way, and still make more money, I think they're going to be inclined to right? So as you said, if we're going to be cancelling this duty, well, we can also decline VAT.
The problem is, the more you tinker, the more you piss everyone off, right?
If they're aware of it. And I guess that's again why I'm so happy to do this show, because at least we can say, well, this is actually what happened.
And of course, we'll keep you up to date when we get that actual budget detail and drill down into it. Thank you very much indeed. And thank you for watching. Don't forget to click on the subscribe button so you can never miss an edition of this show. And do send any thoughts or feedback on what we've had to say and what we've covered. We'll post those in the comments below. See you next week.
Hi everyone, I'm James Brodie, Head of Learning and Development here at Onyx Capital Group, and I'm delighted to welcome you to this immersive course on commodities and financial markets called Trading with Discipline, where we take a deep look into fundamental analysis, technical analysis, behavioural finance and risk management, all based on our one-day accredited programme with the Singapore Institute of Banking and Finance. Across a series of webinars, we'll explore the fundamentals of global markets, starting with an introduction to commodities and energy trading, before moving into key drivers of market prices through fundamental analysis. We'll also provide a clear overview of bonds, equities, and foreign exchange markets, ensuring you have a strong cross-asset understanding. We'll then dive into technical analysis, including trend following, mean reversion, risk management, and program trading strategies. We'll also examine the increasingly vital role of behavioral finance, helping you understand trader psychology and emotional discipline in real-world trading. The course includes interactive trading simulations powered by Amplify Me, multiple choice review tests throughout, a final end of course exam, and a certificate of completion. This program is ideal for anyone looking to develop a deeper understanding of financial markets, sharpen their trading instincts, and build real practical skills for the industry. I look forward to seeing you on the course.
Good afternoon and welcome to this afternoon's European Market on Close. And it was a really interesting one. Come have a look quickly, see what happened here on the deal summary. So we had Midland. Vitol sold twice actually, as we can see here on the chart. Sold to Mercuria and sold to Petroineos. Quite interestingly, same cargoes, same days. So we're looking at this 85-cent trade here, which is significantly higher than the 50-cent we had assessed our curve for Midland for the same days. So that should bring significantly Midland up. Now elsewhere, Mercuria was also lifting 95 cents above dated for Midland the late December. While Mercuria also stepped up to bid for 40s. So 40s, if we look here, same cargo as yesterday, minus 80 cents yesterday, and today was 50 cents stronger. So that should bring a lot our 40s curve, which has been very depressed over the last few sessions. Now let's do a recap to see what this would mean for the physical differential. Yesterday, we assessed our physical differential at minus 73 cents. Which was significantly higher compared to previous sessions. But today we're looking something about 30 cents higher, more or less. So we should be around the mid 40 cent range, minus 40 cent range to be accurate, which is significantly stronger compared to what we've seen in the previous sessions. So that's it in the North Sea. But if we were to look at the price action, now, Brent has been fairly range bound again. We're around the 64 to the mid 63 right now. We had a small dip following the morning to afternoon session. Not even the EIA report could do anything. Nobody has really paying attention to the EIA stats recently. So we remain pretty range bound in the afternoon, as we can see here. But Brent spread had a good rally post afternoon. So we're trading in the 42 cents and now we're in the upper 40 cents, even touching 50. So that's good news. Brent spreads remain very strong according to some traders, which expect them to come to be softer heading towards the end of November or even December. Now, what's particularly strong though is or at least was gas oil swap crack. So we hope you didn't snooze, because remember, you snooze, you lose. So in the morning, following yesterday's rally, we rallied even more to almost 40 cents, as we can see here on Flux terminal on the screen. But we had a huge dip. We fell to 35.50 and now trading around the $36 range. Gas oil has been extremely volatile in the recent sessions, and we should theoretically see some more weakening heading towards the next sessions. That's it in terms of price action over the market. Now we're hearing some rumors that the US is preparing for a peace deal with Ukraine and Russia. Obviously, Russia is not changing their terms, so we'll see how this will play in terms of Ukraine's negotiations. But it looks like the mood is better. Now, that's everything for today. Obviously, keep in mind to pay attention our Twitter account, LinkedIn account, and obviously on the Flux News podcast, where we bring you the best daily updates And that's it for today. See you tomorrow in the morning, Singapore Market on Close. Thank you.
welcome to another episode of Flux Insights. I'm Lisa Aziz, your host for today's exciting show. And joining me for this episode are key members of Flux's research team, Research Associate Meeta Chaturvedi and Quantitative Research Associate Harinder Sandhu. Hello, guys. Nice to see you. Actually, at this point, let's start off with finding out exactly what it is you do here at Flux.
Hi, thank you for that introduction. My name is Meeta Chaturvedi. I am a member of Flux's research team. I'm research associate here. So my team and I, we specialize in the crude oil and refined product swaps. We look at Flux's proprietary positioning data, add to that fundamentals based on just the global macroeconomy, or what's happening in the oil market. And we come up with actionable insights on emerging trends for our viewers or our readers. So we do this in the form of reports. So we've got daily, weekly, monthly reports, and we've got our lovely show over here. So yep, so these insights are in the form of positioning insights in our reports or trade ideas, which we will see in this show as well.
All to come, Harinder.
And I'm a quantitative research associate, as you mentioned, Lisa. So my focus is on unpacking Onyx proprietary data sets. That's the commitment of traders data set that we obtain from our trading activity, really looking at that from a quantitative perspective. I work in with the team on the reports, more from the data angle to providing the insights from a data perspective in my day-to-day.
So much experience. Let's get on with it. And let me start too by telling you what Flux Insights actually is, though, and what you're going to learn in today's programme. So each week, our research team will dissect the latest trends shaping the oil market, which, as we all know, influences everything from geopolitical events, conflicts, inflation, right along to how much our energy bills could increase by or not this wintertime, and how much we might just end up paying at the petrol station to fill up our cars ahead of that weekend trip out. So with Flux's proprietary financial positioning data, we deliver a view of the oil market that you just won't find anywhere else. We're at the forefront of early trend shifts and can convert them into practical, actionable opportunities. So in the next half an hour or so, we'll be covering recent happenings in the market, followed by a positioning review, a deep dive into an interesting swap contract, technical analysis of the oil market, and, wait for it, a trade idea for the week. So with all that in mind, then, let's get stuck in. Meeta, firstly, then, what's been the big mover in crude oil futures this week?
Thank you for that question. So Brent futures, this is just the M1 Brent futures, have been fairly range bound this week. Not a lot of volatility there. But the big thing that has happened in crude futures has been at the end of last week. We saw a Ukrainian drone attack on the Black Sea port of Novorossiysk. Because of this attack, M1 Brent futures climbed from a low of $62.25 per barrel on 13 November to above $64 the next day, and then it hit $65 just on the 18th of November, where it finally met resistance. So it's currently around the 63 handle. Over the weekend, we also saw an attack on Rosneft's Ryazan refinery. No oil product loadings are now planned at Ryazan until the beginning of December. In Novorossiysk specifically, so it's an oil terminal and it's one of Russia's biggest for a lot of oil products. They temporarily suspended oil loadings until Sunday, so it was like a 2 to 3 day halt essentially. Put around just over 2 million barrels a day of crude oil on hold. So that's around 2% of the world's global crude supply, essentially. So as I said, it's come back online. So reports said it's come back online as of Sunday. So things appear to have, so despite that initial rally we saw in flat price because of it, things are looking like they're normalizing finally. There is still a lag. So the figure that I mentioned, just over 2 million barrels a day, that is including Kazakhstan's CPC terminal loadings as well. So these are fairly important crude loadings. And now we're seeing a bit like a 1 to 2 day lag in future loadings just for the time being. That said, just in terms of flat price and who's pricing this in, how the market is reacting, considering that we're back to 63, I don't see a lot of disruption being priced in, and just volatility has been fairly muted. If you look at my chart over here, volatility. So this shows volatility in Brent open in Brent options. So the white line over there is out of the money volatility and out of the money call options. The orange line is volatility and out of the money put options. So the first two circles that we see are spikes that we saw, the first one on around the Israel-Iran war in June, the second when the sanctions on Rosneft and Lukoil were announced. Compared to that yellow circle that we see at the end, we did see a small increase in volatility, but it seems like the market sort of...
That, though, one huge, great big dollop of volatility.
Exactly. So I feel like it's just the market's fairly range-bound right now. It'll be interesting to see how the market is essentially looking at this whole Russian sanctions thing, considering Deputy Prime Minister Alexander Novak also mentioned that crude oil production in Russia, although it did slow down in October, it was below OPEC's quota. It is reportedly increasing in November, and it could match up the quotas by the end of this year. But I think, Harinder, you had more to say about Russia, the sanctions, and what developments are following.
Absolutely, Mita. So as Mita mentioned, the sanctions on Rosneft and Lukoil, the two big Russian majors from Russia, those two companies, there's a number of sanctions that have been placed on them in terms of restricting the activity, but the extent to which those sanctions are actually taking effect remains to be seen. And as Mita pointed out with the volatility, you didn't get nearly as much of an increase as we saw earlier in the year with a huge spike in both call and put volatility. So I think it's interesting to note that in spite of the sanctions being put in, there are a number of exemptions that have been put in place as well. So the most notable one, I think, is the CPC pipeline that Mita rightly mentioned, the Caspian Pipeline Consortium. That's effectively a pipeline between Kazakhstan and Russia, and Rosneft and Lukoil have a pretty integral share in that pipeline, and they're being permitted to continue with their investment in, I guess, their equity share into it and the extraction process for their downstream processing. They're being permitted to continue with that until the 21st of November. So that's coming up pretty soon, that restriction, that timeline. But there are also longer extensions that have been put in place, more country in terms of countries. So Hungary, for example, has been given a 1-year exemption for Rosneft and Lukoil to divest their assets to be able to fully withdraw. On top of that, Bulgaria, Lukoil owns the biggest refinery in the Balkans in Bulgaria, responsible for between 40 and 60% of the wholesale fuel market in Bulgaria, so really pretty massive. And they've been given until April 2026 to be able to withdraw from that. So perhaps this market reaction is in full view of the fact that although these sanctions appear to be rather substantial, there are a lot of these caveats in place to allow the two majors to withdraw their assets, withdraw themselves fully, so the effect won't be so immediate.
Just a word on that Hungarian extension, though. For you guys on the desk, did that particularly take you by surprise, or do you think there's lots of background underlying factors to an extension like that?
Yeah, I think it comes as a show of power politically to say we're going to sanction these Russian companies heavily, but of course they don't want to be so disruptive that the oil is off the grid immediately, so to speak. So to allow them to have the time to withdraw, to allow those assets to find a new home, potentially to find new investment, will keep the oil flowing. If they were to implement them so quickly and not give this cool down period, if you will, then it could have been a lot more dramatic.
For sure. I think with Hungary specifically, there's obviously a lot of political allyship there as well with Trump and Viktor Orban. It'll be interesting to see. I think we're also hearing reports of a potential delay in sanctions now, just generally as well. So I think this is a bit where like the whole Trump Daco play comes into quite focus as well. So it'll be interesting to see how these sanctions are, how the timeline looks on them. I think with these sanctions, it'll just over time, we currently hear reports of, I think I read a report that said something about Russia offering discounted LNG to China. So there is a lot of question about how much of supply is going to be disrupted, because considering that flat price is currently at $63, not at 70 something dollars, you know, I don't exactly know how much of the supply disruption is the market really pricing in.
Exactly. We'll see how that plays out. All right, Mita, let's move on now, if we may, to refined products. What's the latest in particular with the refinery margins?
So refinery margins, as we discussed in last week's show as well, are still very high. They've seen a small correction today, but they remain fairly elevated. However, last week we mentioned that the major drivers behind this strength were gasoline and gas oil. So gas oil remains relentlessly supported, and we'll talk a bit more about that in the section. But I also want to talk about gasoline because that market is starting to look slightly shakier. So the EBOB crack, which again has been so strong, is now starting to see some weakness. It softened from a high of $17 to around $15, $70. Distillates, though, as you can see on my chart over here, distillates remain very high. So I think margins right now, to me, appear very middle distillates versus everything else. Like everything is starting to, like you can start seeing some cracks forming, but middle distillates remains high. We saw around a $4 increase in cracks day on day yesterday. So they reached above $39, which to me is fairly indicative of stop outs as well. We'll see. We'll have our position data come out over the next few days, and we'll see how to corroborate that. But just a day-on-day spike like that does hint at stop outs. We have since seen a correction. I think these levels are a bit too much for the market as well. We are starting to see resistance here. The crack is now at 36.30. And in terms of spreads, so the front month versus second month gas oil future spread was briefly at $45, which again, very indicative of supply tightness, but also demand increases. Assuming as we inch closer to winter, stocks start trickling down as well. And I think we mentioned in last week's show as well, we are beginning to see cold weather. It is so cold in London this week. And that'll be really interesting. Just on the distillate side, because I did say this feels very distillates versus everything else, jet fuel, which is also a middle distillate product, has also been really strong, especially in Asia. So in Asia, we have this contract called a regrade. So regrade is Sing jet fuel essentially versus Singapore gas oil. And that is currently positive despite how strong gas oil and diesel have been. So the fact that that being so strong also is fairly reflective of how strong the jet fuel market is, especially in Asia. A lot of that has to do with seasonalities. Japan tends to use kerosene for wintertime heating. It's fairly seasonal for that, but also from the US West Coast. So we have seen refineries in California shutting down, and recently we saw Chevron's El Segundo refinery catch fire. So there has been a pull of supply from South Korea, and recently India exported its first ever jet cargo to the US West Coast in its history. So we have seen that Asia to US West Coast move in jet fuel. That will be interesting to monitor as well because Thanksgiving is coming up, and that's when aviation travel, motor demand travel should increase as well. So keep
and lots of car travel too.
Yeah, exactly.
Using a lot of fuel.
Exactly. So we'll talk about US gasoline later in the show, but for now, aviation demand in the US West Coast. So do keep an eye on that. On a final note, stronger ICE gas oil has also weighed on the gas oil East-West. So the gas oil East-West looks at Singapore gas oil versus European ICE gas oil. The M1 East-West was briefly at around negative $50 per metric ton, which is among an all-time low for this time of the year. It has since come up. It's around negative 41, but a lot of this could also be due to freight being really expensive, making it expensive to send these cargoes across. Other East-West have also been affected by this, but I think Harinder is going to talk a bit more about that.
Absolutely. As Mita rightly mentioned, the gas oil East-West, we're looking at levels that were previously unseen, around negative $50 per metric ton. As she mentioned, freight as well, being particularly high, being particularly strong during these periods has influenced that. With the NAFTA East-West, which is the one I want to focus on a little bit, with our positioning data is really coming in powerful. So a little bit of context again into the market. So NAFTA in the East, the Eastern NAFTA benchmark, has seen a lot of strength due to these cracking units coming online, which will take naphtha as a feedstock, as an input, and crack it to produce petrochemicals, which are later used for manufacturing plastics. So the introduction of these new cracking units, particularly in Indonesia, has meant that demand for naphtha in the East has been pulled up. Coupled with, of course, the Russian sanctions, less Russian naphtha coming in, and the wider sort of geopolitical landscape around there, it's meant that the Eastern naphtha benchmark has strengthened quite significantly relative to the Western one. And what that's meant is the East to West naphtha contract has widened significantly. So if we take a look at the chart on the screen here, which showcases the price evolution of the East-West, along with our positioning data, we see this continual uptrend in the East-West price. And we actually see that our positioning data is showing that the counterparties have been selling the contract as it's been climbing.
Gosh, that's quite steep, isn't it?
It is, absolutely. So it accumulated in a net position close to negative 3 million barrels as the prices continue climbing. And since then, these people that have entered short have been unable to defend their short positions. They've gone and liquidated. And if we take a look at the open interest as well, it would show relatively flat open interest, which basically means that the players are exiting and entering positions simultaneously. So these short positions coming off is an indication of real removal of those shorts, which is happening if we take a look at the entry price at a loss, effectively. So they're buying back these contracts as the price is creeping higher and higher at a loss. So it just really goes to show that in spite of the positioning, being so deeply short, it turns out that they've been unable to defend those shorts, and now prices have climbed and they're out of the money. So I think that's...
So is it their own fault, perhaps, that they literally misread the drivers or the market?
Indeed it is. Perhaps they thought that these levels are so high for the East-West. Of course, there'll be some hedging component.
For sure. I think it's really interesting that refiners specifically have flipped from net short to net long, but that just means that they've unwound their hedge positions. That's not really something that we see every day, so that's fairly interesting. And also on the point of defending their positions, I think it's really interesting that prices have essentially bounced off of the long entry prices. The 90-day longs did not allow themselves to be out of the money at all through this period. Really interesting.
Really interesting, yeah. So,
right, well, while we are discussing oil products, Mita, I think there's been some news, especially coming out of Nigeria's Dangote refinery. Has there been an update on their maintenance schedule?
Yes. So there's reported updates that Dangote is a 650 kilobarrels a day refinery in Nigeria, and they have reportedly postponed their they've reportedly postponed maintenance on their crude distillation unit till the end of Jan. So it was initially planned for early to mid-December, and they've postponed this for the end of January. The maintenance on their RCC unit, which is used to make gasoline, has been brought forward to 15th December instead. So just in terms of how this could impact oil products, for pushing back, like bringing back their RCC maintenance would be supportive for EBOB, for European gasoline, although levels are really high right now, so we could still see a short-term correction, but there is some support here on lower. For example, if we do see a correction lower, we could see a floor just from this RCC news. Interestingly, also, a delay in the CDU maintenance while the RCC is brought forward may lead to more LSSR, that is low sulfur straight run fuel oil, being sent from Nigeria to Singapore in the short term, which could potentially dampen Sing 0.5, Sing VLSFO as a whole, so in the prompt especially. That should be something interesting to look out for, especially because our positioning data shows trade houses buying the DEX Sing 0.5 crack against Onyx recently. So this could leave these players, these long trade houses, vulnerable to a bearish catalyst, especially with open interest in the crack currently very close to the 5-year maximum. So there isn't a lot of room for them to keep defending their positions in terms of how saturated the market is. So if we do see a bearish catalyst in the market from this RFCC news, from this CDU postponement news, that'd be really bad news for them.
Just on the maintenance issue, though, I mean, most refiners have to do maintenance at some point, don't they? I mean, we hear so often about fires, outages. I mean, that suggests that maintenance is needed.
Yes, for sure. But I think in this case, there has been so much question about the exact maintenance schedule there are so many moving parts here. First, there is the CDU, there is the RCC unit, both of which impact, in this case, fuel oil very differently. Initially, what we heard rumors of were that the CDU would be shut more than a week before the RCC unit, in which case we'd first see support in VLSFO due to a curb in exports from Nigeria to Singapore, and then we'd start seeing more VLSFO supply as the RCC unit goes offline. But now with the CDU maintenance still well in the future, but the RCC maintenance approaching, that's a bit of a surprise news. That's a bit of a shock for the VLSFO markets, essentially, is what we're seeing. So I completely agree. And a lot of times we do see seasonal plays in the market. For example, we start seeing support in Q2 gas oil East-West because of refinery maintenance. We expect Asian markets to be tighter at that time. So we do see the market does price in refinery maintenance. It does also want to look out for unplanned maintenance or random shock news like this, where you see changes that nobody saw coming, essentially.
All right, brilliantly explained. Let's move on now then, if we may, and talk a little bit more about the futures market. Have there been any interesting changes in positioning in particular recently?
Yeah, so there's been a few contracts that have been especially interesting. Of course, to start, Brent, there's been a small increase in the open interest. So in previous weeks, we've seen drops in the open interest, indicating that players in the market have taken off risk. But the real standout contract, as Mita mentioned as well, is the gas oil complex. So if we take a look at the positioning in the producer merchant category for gas oil, this is not too eventful in week on week. We can see that they're maintaining their short positions. But what was especially interesting in the gas oil category was the money managers. So now if we move to the money manager positioning, which is far more indicative of the speculative players in the market, we can see a week-on-week addition of net length. So we saw longs, so this is the net position week-on-week, increase overall by 7.74%. And this is the third consecutive week of increases. What this is telling us is that these speculative players continue to add length to gas oil, and they're doing so at higher prices. So there appears to be perhaps some conviction as prices are moving up, that they continue to do so. These are speculative players, so they're not doing it, it's not for hedging purposes, it's because they do believe with some conviction that prices could potentially continue to move up. So this is the less timely data, the CFTC, but again, it does go to underscore the point that gas oil is the contract where there's a lot of conviction, especially at this time towards the end of the year when players tend to be a little bit more risk off going into Christmas. Locking in their bags, as Mita said, exactly.
Yeah.
So,
Right, brilliant, Harinder. Well, we know that official COT data is lagged, of course, by a week. So what does Flux's timelier positioning data then tell us?
Yes, exactly as you mentioned, the data we just looked at was lagged. We have a CTA model which is capable of giving us positioning day to day, which is far more granular and can give us a lot more insight. So if we take a look at the chart here, which shows the futures contract CTA positioning over time, it's in some sense it's more of the same in that we remain overextended in gas oil and heating oil, as mentioned in previous weeks. In fact, we've seen even more of an increase tick up, which could potentially indicate we're overextended. But it could also suggest a new normal. If this continues to be the case and we continue to see positioning at these high levels, the underlying model that looks at the position will start to acclimatize to this level, and this will become the new normal for positioning. So if money managers do continue to keep buying, do continue to keep adding positions, the CTAs will similarly reflect that state of normality. So it could be the case that these high levels for gas oil will persist a little bit longer as positions remain here. I think one thing to point out that's especially interesting as well with CTAs is RBOB, which is the US gasoline contract, has started to move up to neutrality, so in terms of zero level of positioning, and there remains a little bit of room to the upside in terms of adding positions and potentially supporting prices of US gasoline. This comes in especially interesting for our trade idea later. RBOB is a really important component of the arb between US and Europe, and we'll start to see how this could potentially play into that at the end of the trade idea. So that's one to watch out for.
Mita, go along with that?
Yep, I do agree with that.
Right, let's shift focus now then to the oil swaps market and Flux's very own commitment of traders data. Has there been a recent contract perhaps that's particularly stood out this week?
Yeah, so we did speak about this earlier as well in last week's show. That was our main trade idea then. We're going to talk about the prompt DFL, that is the dated Brent versus Brent swap spread. So this particular contract fell to a low of, as you can see on my chart here, it fell to a low of around 15 cents per barrel just at the start of November, around mid-November. But over there, it saw better buying. And if you see my chart, if you see the next chart after this, you can see that refiners have been primary drivers of this buying. So we initially saw them de-risking, but then we saw them buying at lower levels, buying on the way up. They are now 6.5 million barrels long this contract against Onyx, and they've added 3 million barrels of this just over the past fortnight. So they've not added too much just over the past week. They have still added a muted version, comparatively muted volumes, but they are holding on to these longs, which is important to see. Longs are now in the money, but its current prices are around 63 cents, and the 90-day average long entry level was just under 40 cents. So they're comfortably in the money. And we hold a fairly bullish view of dated Brent over here.
Well, just let's explore that a little further. I mean, what's your view on this contract based on that?
Yes, so On the paper side, as you can see, refiners returning to adding length, buying a lot over this past fortnight, buying at lows. We have seen that floor in the contract. But just on the physical side as well, we see support in the North Sea physical. The physical differential in the North Sea moved up from a low of $1, below $1 at this over the past 2 weeks, to 73 cents just yesterday. This is negative 73 cents, sorry, just yesterday. This is based off the officials' assessments. So do check their show and their reports as well.
Absolutely.
But yeah, so based on that assessment, we have seen a day-on-day increase, a day-on-day recovery in the physical. And yesterday we saw a good bid in 40s cargo by Mercuria, up to 80 cents below dated. This is for early December cargo. And just if you look at the paper market as well, the paper market is also implying more support. We are seeing the 24-28 1-week roll, that's just for the week ahead, 1-week roll, move up from negative 30 cents per barrel on 12th November to around negative 5 cents per barrel just before recording the show. So we are seeing more support being projected, being anticipated in this contract. And should we see the support materialize, we should start seeing this towards the end of this week.
And we're recording the show, of course, on Wednesday, the 19th of November. All right, just taking a break then now from that positioning data. Shall we dive into another interesting way of analysing the market through the means of technical analysis, which uses statistical trends gathered from past data, of course, to derive insights from the market. Mita, could you just talk us through any interesting shifts in the market, technically speaking?
I would love to. So just starting with Brent, just it being the most liquid of our oil futures. So Brent has been, as I mentioned, we have been fairly range bound. 50-day moving average, that blue line on that first pane on that chart, has been a very significant resistance level for this contract. As you can see, just from the past fortnight, like looking into price action into November, it's been a very clear barrier for price action. They're not allowed to go above that blue line. Just from an algorithmic point of view, crossing that blue line by more than one standard deviation or for 1 to 2 trading days as a close above this line would encourage further buying, because a lot of systematic traders would look at this particular level, and that would encourage crossing above it would encourage more buying. Momentum, as reflected on the second panel over there, that is a stochastics indicator that shows how short-term moving averages have been interacting with longer-term moving averages. The fast stochastics line is now is well above the slower one. That shows building positive momentum. But I do think that the 50-day moving average is still something that should be more of a focus over here, because that's been a very important barrier for this contract. And just the second contract I would like to talk about is European gasoline, just because of all the talk about how we are starting to see cracks form in the contract. So this is a really good demonstration of that. So we've seen good strength into Q4. So October onwards, we've seen the December EVA crack just on an uptrend. It's just been relentless, and it increased to a high of over $17 this week. But that's where we started seeing resistance, and now it is currently around just above $15. And just looking at the MACD line on the second panel over there, that shows, again, similar to stochastics, that's an indicator of momentum. And although we are still in the positive here, the MACD histogram is still above 0. It's very barely so. That chart over there reads 0.04, so it is fairly level with longer-term moving averages. So this currently looks at a difference of short-term versus long-term moving average, and then it further smooths that line. So a decline in the MACD histogram below 0 would also be a sell-side signal for a lot of traders. So keep an eye on that, considering that it's currently around 0.
Really close. Yeah.
Yes, very close to it. But on the support side, that orange line that's going up alongside prices is a very important support line to keep an eye on. That is the 10-day moving average. A break below that, which is very important because we are currently testing it, as you can see over there, would immediately open room for the yellow line over there, which is the second line of support. That is a 30-day moving average. And I really like the candlesticks on this chart. So I'm going to focus a little bit on that. So just going on these particular charts over here. Can I circle them? Nope. But just around the 12th of November, we see really small real bodies on those candles and longer shadows. that shows rising indecision in the market. And that is around the time we were at highs that we've seen this week. So that level started to build up indecision in the market, and then we started seeing bearish candles forming. So do keep an eye on how that goes. But on a technical level, on a technical basis, there are very clear warning signs in this contract.
Take us on to the trade idea.
Yes. So the trade idea is related to European gasoline. Herndon's going to take us through that.
Exactly. So exactly as Mita said, I think there's a lot to unpack with EBOB cracks, and rightly pointed out, cracks in the EBOB crack are really beginning to show with the stochastics, with the technicals. And the trade idea really builds off that idea. So we're looking at the ARB, as I mentioned. There's a difference between US gasoline, the EBOB contract, and European gasoline, the EBOB contract. So our idea is that we should be going along the ARB, i.e. buying the ARB. So that would mean buying the EBOB contract, selling the EBOB contract. And given how EBOB cracks are looking right now, we're teetering on the edge. I think that there's a very strong technical argument that can be made there for selling that EBOB contract. Again, as Mita pointed out, that second line could be a good level of support target as prices could fall through. But looking specifically at the ARB, so the difference ARB to EBOB, in terms of fundamental data, so we would look at the inventory data in the US, the EIA data, which tells us about the stocks in the US. Those have actually been surprisingly strong. And ARB hasn't really reflected that too much. So this could be a signal that there could be some reversion up in prices that could be captured. And the other thing that was interesting as well is the actual chart itself. So if we take a look at the price action in the ARB, which has steadily slid down, we're now at levels around 35 cents, which is incredibly low for the ARB to EBOB ARB, and could represent a very strong buying opportunity. So, and then again, the technicals on this chart or on the EBOB crack can further bolster the argument that we're making. So yeah, the ARB I think is a pretty strong buy from our perspective. And in terms of positioning as well, that we've recorded as Onyx, a lot of players have been selling the ARB, and generally that's a hedging activity, but there could also be some speculative interest there. So to lock in that voyage from Europe to US, you'd sell the ARB contract, buy the EUR contract. So that hedge could potentially unwind if we start to see this pick up. And because there's been so much selling flow that we've recorded, Onyx has recorded, that could if that flow was to unwind, similar to how we saw it with the NAFTA East-West, right? When we saw all that selling flow, if that were to unwind, that could really provide a sort of a tailwind to the prices moving upwards. So there's also an argument from positioning to be made there. So all these different factors coming together could really see this contract pick up and be profitable if someone were to go long.
I think especially because open interest in the ARB is currently really high. It's around the 5-year maximum. Same with EBOB. So there is a lot of oversaturation in these markets that leaves these players vulnerable to a reversal. And as you correctly pointed out earlier in the show, Lisa, Thanksgiving coming up, that is definitely a bullish indicator, a bullish driver, potentially bullish driver for US driving versus European driving. So.
Definitely.
Thanks so much to both of you. We've learned so much already, but we're not done yet. Because I'm going to put you on the spot, as we often do towards the end of the show, because it is our crystal ball prediction moment. Let me ask you then, where do you see Brent going in the coming week?
I'll kick off. So I think with the sanctions, I think to start, of course the narrative has now become quite deeply instilled into the market. It's clear to the market's well aware that these sanctions have been implemented. They're now aware of the various exemptions that are in place. So I don't think any more headlines on that front, which was really the big mover earlier on, will be particularly significant. From my position as I see it, given that we're heading into December, as Mita pointed out, traders want to lock in their bonuses. They're not too keen to take on extra risk. The market's a little bit more risk off. I don't expect that we see particularly big movements in any of the contracts. I think for Brent, we're going to be in a relatively tight range. Perhaps for gas oil, that's the one that could be the exception. We've seen it picking up. Although I think we've seen a little bit of a correction lower recently, which could be indicating that those traders are like, you know what, I've made some good money here. Perhaps I'm going to liquidate my positions and take it easy into Christmas. Wow. So I think for gas oil, there could potentially be a little bit of a retracement. But I think for those two contracts, that's my view.
I do agree with that, because I think I'm gonna add a third layer to that. So Brent, I do agree. I think I am a firm believer in that blue line that I showed over there. I don't see us breaking significantly past it, maybe for a bit and then coming lower. I don't see any fundamental reason to believe that it should go above it. But I do think we're going to be fairly supported, and that's because of Brent spreads. So the front month versus second month Brent spread, I think, is currently at fairly low levels, considering it is almost an expiry spread. Expiry being the Brent futures expiry is coming up at the end of this month. And I think just based off that, I see some upside in that spread, which would then keep the futures fairly supported here. In terms of gas oil, I completely agree. I think it's hard to be too bullish over here, but I don't think we're going to fall off a cliff or anything. I think we're going to be fairly supported as the market's super cautious, I think. And yeah, but that said, if we do fall below critical support levels from here, I think gas oil is like the final straw that's essentially like the final thing keeping refinery margins up right now. So if that starts falling, that could be really bad news for refinery margins and then for crude demand. So I hate to end this on a negative note. Right now, I am fairly cautiously bullish Brent spreads. Let's end it on that.
We're going to hold you to that. Thank you very much indeed, Mita Harinder. And that is it for this week's Flux Insight Show. Do hope you've enjoyed it and learned a lot. I certainly have. Huge thanks, of course, to our fabulous research team, Mita and Harinder. See you next week. And remember, for a deeper dive into our research and data offerings, you can visit flux.live and feel free to, naturally, to reach out to us with any questions and comments. See you all next week.
you.